weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The fate of this market seemingly in the hands of one man at a social media account from day to day, minute to minute. The president going into the weekend, turning up the temperature, turning up the volume on the trade story, turning it back down over the weekend. Equities rally bounced back up by 1.5% on the S&P, on the Nasdaq 100 up by 1.6. On the Russell this morning, the small caps up by 1.8. Under surveillance this morning, waiting for September.
There's no question that the shock of tariffs are stagflationary. Is it going to be clear enough by September? I'm just not sure right now. Ultimately, we'll have to see what the data says. Our monetary policy instruments either push up economic activity and inflation or push them both down at the same time. And that's a particularly challenging environment for policymakers to navigate. And that's why so many of my colleagues and I are saying we're really in a wait-and-see mode.
So here's the latest this morning. Federal Reserve President Neil Kashkari doubling down on the FOMC's wait-and-see stance. Robert Sockin of Citi downgrading his global growth outlook, saying ultimately the Fed is likely to put more weight on the risk to growth and start cutting again later this year. Robert joins us now for more. Rob, good morning.
Morning.
New York Fed President John Williams speaks later on this evening, incidentally, said recently that maybe you won't know until at least September what policy is actually going to look like, and they can't act until at least then. Do you think we'll have any clarity after the summer?
I think I have a lot of sympathy for the point that they're going to be fairly frozen during the summer, because right now the economy has been holding up fairly well. You've had a lot of front-loading of purchases ahead of these tariffs. You're not seeing really a ton of it bleeding into prices yet. But I do think once we get into the summer, that data comes in, and especially later in the summer, you will start to see more definitively that prices have moved up due to these tariffs and that growth is slowing down, both because that front loading of purchases has to be paid back and the tariffs themselves will slow activity. So I think by then they should have some clarity, and I expect they'll probably cut rates at that point. But there are a lot of moving parts, so it could take a little longer than that.
So let's go through it piece by piece. At the start of the year, the average tariff versus the average tariff now, and why you're making the assumption that a lot of that will result in higher prices in the months to come.
Yeah, absolutely. I mean, before President Trump took office, the average tariff rate on U.S. imports was around 2.5%. We estimate it's somewhere around 13% with announced policy so far, give or take, depending on some assumptions. When all's said and done, and you end up with probably a 10% minimum tariff on most countries, the sectoral tariffs in place, potentially more sectoral tariffs to come, you end up with something around 15% effective tariff rate by the end of the year. That's a lot better than we were maybe a few weeks ago when the possibility of 25% tariff rate was on the table, but that's still a substantial increase from where we were before, which is why we're fairly confident that these will have an effect on inflation, these will have an effect on growth, but you're not seeing that right now because of those distorting effects I mentioned, the front loading, and also companies are hesitant to put through price increases because they don't know how much of these tariffs are going to stick.
This has been the reason why it's so difficult to really game out how this is going to play out, because everyone's saying the data you can't rely on. So data dependency is out the window at a time when this was a uniquely data-dependent Federal Reserve. At what point does the data have to turn to back up your thesis that we are going to see some sort of slowdown?
Yeah, absolutely. And, you know, and it's a difficult environment to read because you said this, the soft data have been telling one story. Those have weakened a lot. They're still weakening. But the hard data have been quite good. And not just on the spending side where you've been seeing the front loading, but in the labor market where you really haven't seen any layoff activity. Payrolls growth has still been fairly strong. I think I would be surprised if by the end of Q2, so if after June or beyond, that you don't start to see this weakness. If you're still seeing a lot of strength during that period, it could still be that the effects are delayed, but it might be that just the tariffs aren't having the same detrimental effect, that companies are finding ways to cut costs in other ways. Consumers are still being resilient. But ultimately, with the type of tariffs we're talking about, I think there has to be an economic cost, both in terms of higher prices and lower growth. Maybe it's not as large as we're thinking, but that cost is going to come eventually.
If that's the case, does that offset some of the deficit concerns with the one big beautiful bill? Because if you do have tariffs that stick, potentially, as we were hearing from Steve Chiavarone, the revenue raising aspect of that actually goes to support some of what spending there could ultimately be. So could that be a potential offset to some of that weakness?
Yeah, it's a great point. And, the tariffs aren't as large as we would have thought or the risks of them aren't going as high as we would have thought a few weeks ago. And it looks like what's coming out of Congress is maybe net somewhat more stimulative than I would have thought at the beginning of the year. I still think when I look at the numbers that even though effectively they could use those revenue to support other tax cuts, ultimately the tax cuts are not large enough to fully offset the cost of the tariffs. It'll help, but I still think even if you get this reconciliation bill that's somewhat stimulative, you're still going to have an economic slowdown later this year.
Somewhat stimulative. Just build on it. Which piece of the tax bill is stimulative? What are you looking at?
Well, the extension of the tax cuts from 2017 macroeconomically is not stimulative. It has a deficit cost, but those are the tax rates that prevail now. And so if we keep them, it's just preventing a fiscal tightening. But it's the other things that are kind of being debated, no tax on tips, these other sort of tax measures that net would be stimulative. Again, it's unclear how large they're going to end up being at the end of the day. But I think with what's currently being debated, they're not large enough to offset the negative drag from the tariffs.
What the administration would like to see, what they're attempting to encourage, is an investment boom right here in the United States. A lot of money coming home, a lot of production coming home. Do you think that's achievable?
It's really challenging. Even in the data itself, we're not seeing that much evidence of it, even in things like when we do surveys, not seeing a whole lot of appetite. Now, maybe that's because this has been moving so fast and companies don't know what the environment's going to look like. When I talk to companies around the world, also not hearing a particularly large appetite for that. So maybe you'll see it on the margin in some areas. But even if it were to happen, I think it's a much longer-term story that it takes years to plan and do these investments, and you're still living with the tariffs in the short term. So I'm skeptical that that will work to bring back a large-scale production, and even if it does, it's going to be a long time before you see those benefits.
There's sort of two ideas that have been baked into the market. On one hand, there's going to be a slowdown, and that's a good thing because that's going to cap some of the inflation. Then there's a slowdown, and that's going to be even worse because it's going to allow the stagflationary environment to go down. And then another group that says, well, if it's a slowdown and it's not recession, it's fine, it's okay, it's healthy. Where do you fit in with this? I mean, at what point is a slowdown really problematic versus just something that is natural, part of cycles, and could actually curb inflation?
Yeah, on the recession point, I think if we were going back again a few weeks ago where things looked even more uncertain, and especially around the worst case scenarios with where tariffs could go, we were warning of a pretty high risk of recession. I think that's diminished, and we're now more in the camp that you'll probably get some type of modest slowdown that's manageable, not recessionary, but recession risks are still on the table. I'm still in the camp that this will have a meaningful economic cost. Right now, we haven't seen that. A lot of it's been theoretical. But I do think you're going to see, deterioration in the labor market. You're going to see the unemployment rate move higher, and you're going to have lower growth than you would have had otherwise if we didn't have this tariff policy and trade uncertainty. So ultimately, I think it's a difficult story, and I do think that you're going to have that stagflationary environment temporarily, which is going to put a lot of challenges on the Fed and markets in general. So net, I come down on that. If we didn't have this type of policy shift, we would have had growth probably above 2% in the U.S. and inflation near 2%, a gradually easing Fed. That's a much nicer environment that I think we're going to end up once we get to the second half of the year.
If we see that step down in global growth, where's that pain concentrated? Outside of U.S. borders?
Yeah, absolutely. And, right now it's largely in the developed markets. So, of course, the U.S., I think, feels a lot of the pain. After that, we have a fair amount of growth slowdown in Europe, especially compared to where we were a few months ago. A lot of that's due to this trade uncertainty that we're seeing persisting. Beyond that, we have relatively solid growth still in emerging markets. But if you get things like the reciprocal tariffs that Trump had threatened on April 2nd, if those come into play, you're going to see a significant markdown in emerging market growth because things like tariffs on Vietnam were threatened at very high levels. Korea, they export a lot to the U.S. Right now, we have solid growth there, but if those tariffs come back into play, that's where you're going to see a lot of markdowns.
Rob, appreciate the time. We'll see you July 9th. Maybe before then, obviously before then. Robert Stocken there of Citi, thank you, sir. Up next on the program, Roosevelt Bowman of Bernstein Private Wealth Management, Henrietta Trays of Vader Partners. We'll catch up with Patrick DeHaan of Gasbuggy and Gennady Goldberg of TD from New York City. You're watching Bloomberg TV. The most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country and how many people have another problem called illiteracy or illiteracy, right, which means they can read, but they don't choose to read?
It's a challenge with the digital age because they're reading on tablets, so we do count that as reading. If you have an e-book, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Feels like a lot of the good news was already priced in.
We still like U.S. stocks for the long run. I'm not talking about the end of U.S. exceptionalism.
There is literally no alternative to the U.S. dollar and U.S. assets.
U.S. is your best investment destination.
Our view was one of U.S. exceptionalism would get long in the tooth, and so diversify your exposure.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 firmer, higher across the board here on the S&P, up by 1.4% as the president extends the tariff deadline for the Europeans. The Nasdaq up by 1.5%. In the bond market, stability, a bounce back. Yields are lower by 5 basis points. The 10-year 446, 30s a break of 5% at 497. The rally born in Japan. The Ministry of Finance looking at maybe tweaking issuance in Japan, which is having some consequences worldwide this morning.
My narratives are getting scrambled. I just want to tell you, I can't tell whether I should focus on trade, whether I'm still focused on the big, beautiful bill from last week, or whether I'm focused on Japanese financial policy and their issuance of 40-year bonds, which are going to be issuing tomorrow, and their long-term trajectory for long bond issuance. It really comes to show we don't have a full understanding of what exactly is behind some of the moves that we've seen in the market that have been fundamentally undermining long-pinned beliefs in 60-40 and some of the investment theses that people have been having.
It's the return of an uncomfortable correlation, the breakdown between bonds and stock, and the fact that the two asset classes are moving in lockstep that has spooked some people. Japan's had a big role to play in all of this. It has been a global bond market story. You mentioned the 40-year supply coming out of Japan in the next 24 hours. Tomorrow, you'll get 5-year notes in America. The day after, 7-year notes as well. That's going to be in focus too after the very soft, can we call it very soft, 20-year auction that came out of the US just last week.
Do we get a sense of instability in terms of bond yields and a potential buyer strike at a time when we are talking about a fiscal deficit as well as trade policy that has left a lot of people's heads spinning? And I think that that has been the fundamental question that a lot of people have been trying to answer. What struck me is that we're getting a different answer from every single fund manager who comes on the set. Some are saying, yes, I am fundamentally changing my view. I do see European and Canadian investors pulling back, rethinking their American investments. Other people saying that's hogwash. When they realize that they're going to put their money first, they're still going to come back to the U.S. because there is no alternative at the end of the day. And those are going to be the two competing narratives throughout the end of the year. And we're going to be using each auction to sort of lean on one side of the narrative or the other to justify it.
Going to be a very interesting summer. July 4th. July 4th is the goal, the ambition to get the tax bill through Congress. July 9th is when that 90-day period of discussions, negotiations between the U.S. and the rest of the world regarding trade is complete. So by July, we should have a decent view of the world, shouldn't we?
I mean, sure. I guess that here's the question. What is that decent view of the world? Is it the big, beautiful bill? To me, I think that's probably more likely that we do get some semblance of what that looks like and how feasible that will be to get passed through the Senate. As far as the trade deals go, can you really get some resolution to the VAT tax, to the regulatory overhang, to the potential other regulations on U.S. tech companies in Europe quickly enough to get to that July 9th hurdle? That, I think, is a bigger question mark.
Equities this morning, at least, a calm start to Tuesday morning. We're doing better, up by 1.4% on the S&P 500, and a rally in the bond market. Coming up this hour, Roosevelt Barman of Bernstein Private Wealth Management. As policy weighs on growth expectations, we'll catch up with Henrietta Trays of Vader Partners on President Trump's EU tariff delay, and Gennady Goldberg of TD Securities as global bonds stage a comeback. We begin this hour with stocks higher, following the president's tariff reprieve. Roosevelt Barman of Bernstein Private Wealth Management writing, we anticipate weak U.S. growth in 25 of about 0.5%, given the current higher cost of capital and the uncertainty around tariffs. Roosevelt joins us now for more. Roosevelt, good morning. It's good to see you.
Yeah, good morning, John. Good morning, Lisa.
Thank you for being here. A step down in U.S. growth from around 3% to 0.5. Can you walk us through how well-priced bond markets are at the moment for a world of growth, in the U.S. at least, of 0.5%?
I would argue not very well priced at all. I mean, I think when we look at where growth is likely to move over the next couple of months, and really without policy support, you know, we're talking about the tax bill, not quite there yet. And when you think from a monetary policy standpoint, the Fed not ready to cut because we haven't seen enough progress on the inflation front, you're likely to see some weaker labor and consumer data over that time that eventually pushes yields lower. I think the reason we haven't seen that yet is certainly that policy volatility. When you think about some of the potential legal challenges to replacing the Fed chair, thankfully that rhetoric has pulled back, but that's certainly kept yields, I think, elevated above levels that you would anticipate given the growth outlook going forward.
What are your assumptions on inflation with the growth outlook you're expecting?
So, I mean, our assumptions are that inflation kind of remains elevated over the short term, but that when you look more 6 to 12 months out, that you don't have the kind of high inflation or even the stagflation that's talked about a lot. I think from our perspective, the reason that so many people are worried about it's understandable. You think about tariffs pushing up prices, But from our perspective, that only happens if consumers can meet the higher prices. And, I would challenge the consensus view that we've seen this dichotomy of soft data has been really weak and that the hard data has still come in fine. When you kind of look at some of the high frequency consumption data, credit card transactions, the ticket sizes associated with them, it's shown some real weakness in the consumer over the past couple of months. We're seeing that weakness in labor demand as well. When you look at online job postings, the salaries associated with them, they're both at 15-month lows. You look at Atlanta Fed wage data, that spread between those that are staying in their job and those that are leaving their job, it's just absolutely collapsed. So you're not getting any premium for leaving your job. The kind of the leverage is shifted from the employee back to the employer. That speaks to lower wages going forward, lower consumption, consumers not meeting those higher tariff-induced prices.
So this morning, it seems like there are a couple of schools of thought among investors who've come on the show. You've got Steve Chiavarone saying that actually he sees equities as a better bet than bonds right now because he does think that growth is going to reignite later this year. It sounds like, and correct me if I'm wrong, you actually prefer bonds later this year to equities if you do see growth meaningfully slowing and sending people back to what has been and maybe will continue to be a haven asset.
I actually think, Lisa, there's a pathway for both to kind of do better towards the end of the year. So to your point, once we have some slowing growth over the near term, I think that, and once we have policy kind of more sort of knowns about what the tax bill looks like, then you have the pathway cleared for bonds to do well. I think equities, you're going to take some type of stimulus and support, and that's more likely to be, I think, from the Fed than necessarily the tax bill. And that's more of a kind of fall and winter story where the Fed actually has a green light to cut from both the inflation standpoint and the weakening economic data.
So we were talking about this with Robert Sokin, just how quickly we can see the negativity bleed into data that has been very distorted by front loading and a whole host of other factors before people start to question this theory of a rolling over in an economy that has been incredibly resilient with companies adapting and adjusting and figuring out ways to keep on keeping on.
Well, I think we're starting to see some of that, as I mentioned, from both a consumer and labor standpoint. And as people are still concerned about their job prospects going forward, they're likely to pull back on their consumption. That's typically what we've seen in history. Even if we haven't observed so much of that in retail sales, there's been some weakness there. And again, I think the high frequency data have shown that consumers actually are pulling back and are not quite as resilient as maybe the top line figures have suggested.
So there's also this theory underpinning what you're talking about, which is that eventually money will go back into the U.S. and U.S. assets that have traditionally been havens. Why do you have that conviction at a time where people are selling the dollar and you are seeing a move out of U.S. assets, particularly among European and Canadian investment firms?
Well, I think we can separate, kind of fixed income and equities for a moment. So if you think about fixed income, understandably, there's been a premium there because of the policy volatility. So you may not see the size of the rally in bonds that you would normally anticipate with slower U.S. and global growth. I think equities from a long-term perspective, that is a tougher short because you're not just taking a geographic position, you're taking a sector position as well, given the U.S. leadership in technology. So, we talk to our clients and saying, hey, do you want to be short technology for a 5-10 year period? The answer is a resounding no, understandably. So I think that is where we have confidence that, yes, there is a risk premium for U.S. assets that was not there before because of the trade and monetary policy volatility. But the idea that we have this mass divestment into other options, that's not our view at all. And I think that, I think number one, the depth and size of the U.S. bond market, and number two, the leadership in technology says that both U.S. fixed income and equities will be attractive going forward, just not as attractive as before.
What do you think the dollar weakness speaks to then? What do you think is ultimately behind it over the past few months?
Oh, I think in terms of the dollar weakness, for sure, that is where you can express more of that concern about policy volatility. And if you're thinking, when you look at the dollar, it's undervalued over the short term, kind of based on, nominal interest rate differentials. But for longer term measures, you could argue that it's been overvalued for a while. So I think it's a combination of long-term overvaluation, short-term undervaluation, and you end up with some dollar weakness. I think the other part of it too is that the Fed, when you think about the range of outcomes for Fed policy, you're more waiting for them to cut. You don't have the other side of the distribution where you're saying, oh, could there be price pressures that would have hikes that would really widen the interest rate gaps enough to overcome the policy volatility. So you end up with the dollar weakness that we're seeing right now.
They've certainly taken those hikes off the table, that's for sure. Roosevelt, this was great. Let's do it again soon.
Absolutely.
Good to see you. Thank you, sir. Roosevelt Bowman there of Bernstein Private Wealth Management. You will hear from John Williams, New York Fed President, over in Tokyo, Japan, a little bit later on this evening.
Evidently, the Japanese bond market is so important that the entire Federal Reserve is over in Japan right now talking about fiscal and monetary policy. It just sort of goes to show this is very much a global central bank territory, and maybe this is really what's behind, I don't know, maybe it's the Japanese bond market that's been dictating all of the turmoil in the global bond market.
The Fed controls the front end and Japan controls the long end. Actually, how we're doing this?
Actually, you know what? Actually,
like that.
you've got to trademark that, because I've got to say those life insurers, they've got a big role to play.
The bond bouncing back this morning, at least. Bonds worldwide, yields are lower across the board. Equities bouncing back too. Equity futures higher by 1.4%. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Ahmed. Hey, Yahara.
Hi, John. European auto sales fell significantly in the month of April, with none feeling the brunt more than Tesla. Sales of the EV maker fell by roughly half in the month, totaling just over 7,000 units, as it continues to lose market share. At the same time, Chinese EV maker BYD outsold Teslas in the continent for the first time. Meanwhile, President Trump wants to cancel all federal funds directed to Harvard, according to the New York Times. The Trump administration has already frozen $2.6 billion in federal research money for Harvard and moved to block it from enrolling foreign students. Its actions are part of a broader effort to address what it perceives as rampant anti-Semitism at the Ivy League. And Charles Rangel, the longtime Democratic congressman from Harlem, has died at 94. As the first black member of the House Ways and Means Committee, Rangel championed tax legislation to benefit inner cities. House Minority Leader Hakeem Jeffries issued a statement calling Rangel a trailblazer, change agent, and champion for justice. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, President Trump backing down.
You spoke to European Commission President von der Leyen. Did you discuss the 50% tariff?
She just called me, as you know, and she asked for an extension on the June 1st date. And she said she wants to get down to serious negotiation.
And she got that extension. That conversation up next with Henrietta Trays of Vader Partners, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Stocks bouncing back from a 4-day slide on the S&P 500, positive here by 1.4%. On the Nasdaq, up by 1.5%. Apple, following an 8-day slide, is up by 1.6%. That's the name to watch going into the opening bound. Then, of course, we get earnings tomorrow, so look out for NVIDIA later on in the week. In the bond market, you're probably wondering where fixed income is trading. It's trading better. Yields are lower by 5 basis points on a 10-year. We're down by 6 on a 30-year. A lot of speculation and reports that maybe the Ministry of Finance in Japan is considering tweaking bond issuance. That unleashed a big rally at the long end of the curve in Japan, which spilled over into worldwide global bond markets, including the Treasury market, with yields down across the board at the long end of the curve right here in the US. That's the situation in markets under surveillance this morning. President Trump is backing down.
You spoke to European Commission President von der Leyen. Did you discuss the 50% tariff?
She just called me, as you know, and she asked for an extension on the June 1st date. And she said she wants to get down to serious negotiation. We had a very nice call, and I agreed to move it. I agreed to do that, and that she said we will rapidly get together and see if we can work something out.
So here's the latest this morning. President Trump pushing back a tariff deadline with the European Union to July 9th from June 1st. The EU now looking to accelerate trade talks before 50% tariffs come into effect. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, we had a feeling things weren't going very well. The president has called the Europeans nasty, and in some cases nastier than the Chinese. Tyler, just what is at play here, and how high, how big are the obstacles to a deal?
Yeah, hey, John. Well, the stakes are high and the obstacles are also really high here, as we know that the White House has said that its frustration has been that they are negotiating with the European Union as a bloc. But meanwhile, the EU says that really at the end of the day, they don't have much clarity on exactly what the U.S. wants to see. We are starting to get some details about what's not going to be enough for a deal. For example, the U.S. rejected an updated proposal from the EU last week that would have done a range of things, but included both sides lowering their tariffs gradually down to zero for certain agricultural products and industrial goods. That was not enough for this White House, though we do know that the U.S. wants to see the EU boost its imports from these sectors, as well as in particular U.S. LNG. We do have new reporting this morning, people familiar telling Bloomberg News that the EU is going to start to tailor their approach to these negotiations to focus on some of those critical sectors, those industries that have been subject to Section 232 investigations from the U.S., like chips, autos, steel and aluminum, also importantly pharmaceuticals, one that we really should be watching closely here since it is a top export to the U.S. and something we're expecting President Trump to really renew his focus on in the coming weeks ahead of some additional sector-specific tariffs there. So, John, we're going to have to see how this really does work out, because at the end of the day, we know the U.S. wants to see more progress on those non-tariff barriers like regulations, digital services taxes, how big tech companies are subject to fines from antitrust investigations. It really is a pretty wide range when it comes to this, and perhaps one of the biggest ones that President Trump has singled out, the VAT value-added tax, appears to be a red line.
Tyler, do we have a sense of how much the U.S. wants Europe to push back on cheap Chinese goods that are going into the region, or how much they want them to constrain trade with China going forward?
Well, the U.S. Openly has said that that's not going to be really the main focus here, but between the lines, we have seen some indications, including from that updated proposal that the EU did float to the U.S. last week. It didn't explicitly say that, but it did say that they would work when it comes to overcapacity, particularly on semiconductors, and there sort of was some reading between the lines here that that would have be used to help bolster against the broader argument to help build up against China. Ultimately, we're going to have to see if that ends up being such a big driving factor here, since, Lisa, there are just so many different things that they are contending with.
Tyler Kendall with the latest in Washington. So we have some kind of deal with the UK, some kind of truce with the Chinese, and ultimately a bigger stick waiting for the Europeans on July 9th. Henrietta Trays of Veda Partners joins us now for more. So, Henrietta, when we get to July 9th, there's a big stick waiting for the EU now. How much will that incentivize talks in the weeks to come?
Yeah, absolutely. I mean, we had Liberation 1.0, and that created 10% tariffs on the entire world. And Liberation Day 2.0, I think, is going to be an increase or an uptick in tariffs around the globe, with a particular focus on the EU. I think they're one of the most at-risk nations right now, seeing higher tariff rates. And here's why. The president's threat for 50% tariffs is too high. It would cut off trade and be an effective embargo, just like we saw with China earlier in the year. But with the EU, we have a situation where the Liberation Day tariffs would bring them to 20%, and the sectoral tariffs would bring their number one export, pharmaceuticals, to 25%. That's the rate that President Trump has put Section 232 tariffs on everything from, beer cans to automobiles. So that's the direction that they're going. But 50% and that imposition rate would actually put pharmaceuticals at an advantage compared to other sectors, which is nonsensical. So effectively, my point here is that the entire threat of 50% never made sense in the first place. However, rates do need to rise up from 10% because they're not going to get a deal on the major agriculture components that have plagued the two nations for a century or more. So those are the negotiations that they need to take. It'll take some time, and I think tariffs have to rise first.
It begs the question, July 9th, we've got a self-imposed deadline. Do you see that as a deadline, or do you see reason to believe this is going to be an ongoing feature of the president's second term?
An ongoing feature, no question. I mean, South Korea, one of the allies that Secretary Bessent and Howard Lutnick have been saying we were going to get a deal on for 2 months now, has yet to come to fruition. And their own presidential contenders are saying we need a delay even after the June 3rd election. So even the sort of lowest hanging fruit nations, South Korea, Japan, even nations we already have free trade agreements with, have no deals. So my expectation is that across the board, we need at a minimum an extension of the 90-day reprieve with just the 10% tariffs, and I would definitely put that in quotes, as we see the largest amount of revenue come in on Customs and Border Patrol in recent history from these tariffs. But they're all going to need to either be extended or, in the case of the EU, get a ratchet up and then also an extension.
Henrietta, we were speaking with Terry Haynes earlier of Pangea Policy, and he said that there was a geopolitical element to this as well. He talked about the potential for secondary sanctions on Russia to be held as some sort of negotiating chip in discussions with Europe. Do you agree with that? Do you think that increasing talk of the potential for additional sanctions on Russia could be part and parcel of some of these negotiations?
It's interesting you mention it that way. I was actually with some former administration officials over in London last week, and they were talking exactly about the price of gas where it is now. Where I am, it's $2.73 a gallon. You can actually start to impose secondary sanctions on Russian exports of oil to China or India or other nations and get that successfully done. There's a tremendous amount of pressure from Republican senators to move a sanctions package. This administration has been incredibly resistant to sanctions on Russia, but President Trump has obviously not been effective in ending the Ukraine-Russia war in 24 hours. As he promised on the campaign trail. And there's a long way to go there. So I think sanctions, especially as we get into like July and August, are going to become a real possibility and likelihood, and maybe something that the senators force the president to do after they pass this tax bill.
Do you think that, Henrietta, and this is one reason why I think a lot of people are trying to wrap their heads around what is and isn't a part of some of these trade negotiations, could this be used as a chip to go to the Europeans and say, look, we're actually taking a harder stance. Now give us better treatment when it comes to regulation around our tech companies, or give us better treatment when it comes to buying our chickens. I mean, do you think that that's sort of a relevant way of looking at some of these trade negotiations?
My favorite way to ingratiate myself to European clients is to talk about how they're never going to accept our genetically modified chickens or lower their phytosanitary standards. So I don't know that even this is enough to move the needle there. They take great pride in not taking our poultry, but certainly something to keep in the dialogue when it comes to digital services taxes and other pieces.
Henrietta, just want to finish on that tax bill. How you think things shake out in the end? We know the version that left the House. What does the version that leaves the Senate ultimately look like?
Looks like more deficit spend, shorter duration tax extensions on the things that Trump promised on the campaign trail, and some really fancy budget footwork, use of the current policy baseline, which I think the bond market is very aware of and not going to like very much. It's a rocky road ahead, but I've got 70% odds that this passes by the time we need to get to the debt ceiling hike, which is roughly July 24th in the House.
So later this summer. Henrietta, thank you. Henrietta Trace there of Vader Partners, finishing on the bond market there and what could come out of the Senate. The 10-year, the yield is lower this morning, and it has absolutely nothing to do with Washington and a whole lot to do with Tokyo, Japan.
And what they're taking a page from Janet Yellen in a way, and what the Treasury Department did under her rule, which was when there was concerns about the deficit, just simply issue more in the front end of the yield curve. And maybe they're not going to go to that kind of extreme in Japan, but they've taken notice of what's happened in the Japanese bond market, and they want to maybe issue a bit less of the ultra long bond. Again, I mean, talk about a scrambled mind. So one day we're talking about the deficit jerking around the bond market. The next day we're talking about the Japanese Ministry of Finance jerking around the global bond market. It just highlights how we're in search of the correct narrative to frame a market that has been operating in some strange ways.
Because you can't reduce it to one single geography. It's been a global story. I think it's been pretty consistent over the last several weeks that Japan has been a big piece of this puzzle. Now, whether this takes this out of the picture completely, I don't know, but it's certainly an ongoing issue for the global bond market.
Although I completely agree with you, you pair that, though, with a weaker dollar. And that's the reason why people are talking about the deficit. And at what point do you end up with a U.S. problem, even if it is a global bond market sell-off? And I think that still is persistent, but you are correct. The Japanese seem to control the long end, and the Fed seems to control the short end.
The dollar stronger this morning against the euro. Euro-dollar negative by a third of 1%, 113.48. Up next on the program, Patrick DeHaan of Gas Buddy on expectations for a busy summer travel season. That conversation just around the corner, live from New York. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It's a quiet, calm start to a shortened trading week. The calendar's light. Tomorrow, a read on the Fed's thinking, Fed minutes. The day after, a read on the labour market, jobless claims. The day after that, on Friday, a read on the inflation, PCE, and UMich consumer sentiment. Within that, of course, we look for those inflation expectations, which has basically become a political poll and no longer really an economic survey for many of you, I know. In the equity market, equity futures bouncing back by 1.4% on the S&P following a 4-day slide. The president causing a little bit of chaos for the equity market going into the weekend, threatening 50% tariffs on the EU, extending that deadline until July 9th, unlocking some gains this morning across the board on the Nasdaq 100 higher by 1.5%, unlocking some gains in the bond market. The Ministry of Finance in Japan, a lot of people speculating whether they're about to tweak bond issuance, maybe lighten up on the long end, which would take some of the pressure away from the bond market worldwide. Yields lower stateside as well, down by 4 basis points. The 10-year 446, the 30-year a break of 5%. We're down 6 basis points on the session, 497.69. That's the cross-asset price action. We're 2 hours away from the cash open. Let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. You mentioned the data we have coming this week, but perhaps the most important event comes after the close tomorrow, and that is NVIDIA earnings. You can see here shares up 2.4%. Ahead of that, you also had some Reuters reporting over the weekend that they're looking at offering cheaper Blackwell chips to China. China sales and what they can do to supplement it, given some of the restrictions, is going to be a big point of concentration in the earnings report tomorrow. Also, some deal news. Bloomberg before the weekend had covered and reported that Salesforce was looking at yet again buying Informatica. Well, we had some news from the Journal in the last hour that we are getting closer to that deal. They also put some numbers around it, about $25 a share. You can see in the pre-market we're trading just under that, so the premium not fully priced in, but those shares up 6%. Salesforce shares, those are up 1.6%. Finally, wrapping things up with AMC reporting that their Memorial Day weekend was the biggest haul of revenue that they've ever had for that particular holiday weekend. When it comes to attendance, it was its highest figure since 2013. They cited a new Lilo and Stitch movie, a new Mission Impossible movie. I'm going to be honest, I haven't seen that. The reviews are really mixed, and if you're going to convince me to sit for 3 hours, it needs to be near perfect.
Danny, I agree. Thank you. I did watch Mission Impossible, though, over the weekend.
You did?
And it was pretty decent.
Really?
Yeah.
3 hours?
Yeah,
thought
all
that
3
was
hours.
good? It was all worth it?
It was probably... Tom Cruise did it again, for me at least.
Was it just bubblegum? Was it basically bubblegum for 3 hours, and it basically would deliver it on all the stunts really well?
By bubblegum, what do you mean by that?
That was really stimulating, and you walk away not really thinking about anything?
No, this is a decent storyline.
Okay, all right,
Builds
good.
on... Did you watch the first part
Yes.
of... Okay.
So then it...
No, it builds on it nicely.
Okay. Lovely, lovely. Look at that.
Endorsed.
Yeah.
All right.
80%.
Let's get to our top stories. On our radar this morning, President Trump saying he is, quote, absolutely considering new Russian sanctions after a third night of drone strikes. Trump posting on Truth Social, quote, Putin has gone absolutely crazy.
Yeah, and he went on to talk about this with reporters. I'm not happy with what Putin is doing. He's killing a lot of people. I don't know what the hell happened to Putin. I've known him a long time, always gotten along with him, but he's sending rockets into cities and killing people, and I don't like it at all. So here raises the question of, is he willing to go the extra step for secondary sanctions? And to the point that we were just talking about with Henrietta Trey's, does the fact that oil prices are a lot lower give him the flexibility to actually engage with secondary sanctions, even if that could potentially raise oil prices?
And the relationship between this story and ultimately what happens in Europe on the trade front, I think is important too. Just an update on that. The EU looking to accelerate US trade talks as President Trump extends the tariff deadline. Sources telling us here at Bloomberg, the European Commission is focusing on critical sectors, including autos, chips, and a whole lot more.
To me, it was really noteworthy that before the weekend, people didn't take it seriously that there were going to be 50% tariffs. Yes, there was a sell-off, but it wasn't as serious as you would think, given the fact that economists across Wall Street expected there to be some sort of de facto recession in Europe should these go through. The rebound, though, gives you a sense of how people do have faith that we are going to get some sort of semblance of something by July 9th, even though the laundry list of grievances is really quite long, and it's hard to understand how you get past some of these non-tariff barriers that are sort of entrenched in the system.
We've talked so much about what trade and these tariffs would mean for the US economy. We've got to talk about what it means for the European economy too. European auto sales falling in April thanks to lackluster demand. Sales of gas and diesel models posting the biggest declines, outweighing EV growth, with the exception of Tesla, which saw sales roughly halved just last month.
And you saw China's BYD selling more EVs in the Euro region than Tesla for the first time on record last month. So it goes to really underscore this question around political protest driving some of the lack of Tesla sales. On a broader level, though, what's going on with auto sales in Europe is really telling in terms of consumer demand and just how much things are softening. And it raises a question. If people are going into European equities because they see that as the bastion of growth, is this a warning sign? If people don't have the conviction to buy cars at a time where a lot of people are saying, if you wait, the prices are going to go up. I'm trying to wrap my head around that, and I'm not really making sense of it.
Then a warning for the Europeans came on Friday. Threat of 50% tariffs on Europe. That threat is going to hang over them until July 9th. And if you're long on Europe, you've got to tell me what the path ahead is if those tariffs go through.
And it raises the question, in the U.S., ahead of tariffs, you saw people buy more. You saw people buy more cars. You saw people stockpile more stuff. In Europe, is the response the opposite, to sit on your hands and stockpile cash? Why aren't you seeing that kind of front-loading behavior in Europe? And if that's the case, is there a greater degree of weakness under the hood that really is present in some of the economies?
That's the latest for the Europeans. Let's bring it home and turn to travel. GasBuddy predicting resilient road travel this summer. Despite ongoing economic uncertainty, the company which helps drivers track gas prices is predicting the average price per gallon will be just over $3 through Labor Day. GasBuddy's Patrick DeHaan joins us now for more. Patrick, welcome to the program, sir. I know you just put out your travel survey for 2025. Just share some of the results of that survey with us this morning.
Well, good morning. Great to be with you. Yeah, a lot of Americans going to be hitting the road, as we always do, for the summer driving season. 69% of respondents said that they'll be hitting the road at least once for a major road trip this summer. Now, that is down slightly from last year. 76% of Americans said that they'll be planning to hit the road last year. I think a lot of that is because of the economic uncertainty. Some of the trade war layoffs we've seen in some U.S. companies giving a little bit less confidence to Americans. But certainly for the 69% that is going to be hitting the roads this summer, it's going to be a good time. Average gas prices at their lowest summer level since the pandemic. And if you adjust for inflation now, Americans spending the least amount of time to fill their tank up, if you exclude COVID, since 2003, all of that giving confidence to the amount of Americans that are going to be hitting the road this summer, with 26 states now below $3 a gallon. As you mentioned, there is the possibility that we could even see the national average falling below $3 a gallon as we progress through the summer.
If that's the case, Patrick, does that speak to sort of a resilient mood in U.S. consumers at a time where there's speculation that there's going to be a fall off in the economic activity? Or is this domestic travelers deciding to stay home and use their cars rather than fly or engage in more expensive means of vacationing?
Well, I think consumers are a little bit caught right now between the headlines talking about trade uncertainty and which direction the economy may be going in. Consumer sentiment is still rather low, but then you have a subset of users, at least the GasBuddy users, who are very optimistic that low gas prices are kind of leading to this rare circumstance that, hey, the economy is still strong and we're going to hit the road this summer. In fact, nearly 50% of respondents said that they'll be traveling for more than one major road trip this summer. And this comes against a backdrop, like I said, the national average could actually fall below $3 a gallon as we progress through the summer. And it's those uncertain headlines that could lead to those lower prices. That is, as we mentioned here, the price of oil, a big factor. Will there be a nuclear deal with Iran? That's certainly on the table. President Trump hinting that something could be close there. The price of oil this morning still struggling for direction. As you mentioned, though, also Russia potential sanctions are something that are going to be watched as well for this summer, as that may prevent gas prices from falling below $3 a gallon if Trump were to put sanctions on Russia's crude oil.
Can you build on that, Patrick? At what level do gas prices have to stay for people to really travel in the amounts that you're expecting for all of those 2 road trips going over the summer? Is it sort of $3.50? Is it $4 a gallon?
Well, I think as the price of gasoline has fallen really for the 3rd straight Memorial Day weekend, right, since peaking in 2022, Americans are starting to establish a new sense of normal. And for that new sense of normal, are having to see gas prices stay in the low $3 range. gas prices have been remarkably stable so far this year. So if we start to see prices inching back up towards that mid $3 a gallon range, combined with economic uncertainty, you could see more Americans saying, well, maybe I won't take the risk this summer. But if you see the national average falling below $3 a gallon, the headlines will likely follow, and that probably will instill some consumer confidence for later this year that potentially we will hit the road. So I think the $3 a gallon mark is a very critical psychological point for many Americans. If we do go a little bit higher, that may be enough to shake the confidence of some who are on the fence with the economy still a little bit stuck in neutral as well.
Hey, Patrick, appreciate the update. Let's do it again soon. Patrick DeHaan there of Gas Buddy on the latest for energy prices across this country. That one right there, a key focus for this president, as we know, who repeats these stats repeatedly.
Yeah, well, he also talks about $1.98 a gallon.
Which we can't find, granted.
Which, yes, has been difficult to find, although when I was in Texas last week, it is really cheap. It is below $3. It is about $2.50 per gallon. And you do have to wonder at what point that offsets some of the concerns about higher prices and, frankly, enables companies to, on the margins, and I'm thinking of Walmart, kick up prices just a touch because people have that extra money in their balance accounts.
It provides consumers with some comfort at a time when they've been very squeezed for a number of years. That's the latest on gas prices in this country, with an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara Arnott. Hey, Yahara.
Hi, John. King Charles has arrived in Canada to open a new parliamentary session at the invitation of Prime Minister Mark Carney. The King is expected to read the throne speech written by Carney's office that will lay out his government's priorities, including a push to negotiate a new economic and security relationship with the U.S. Meanwhile, for the first time in half a century, Southwest is ending its two bags fly free policy. Starting tomorrow, customers will have to pay for checked bags. According to Reuters, it will cost $35 for one checked bag and $45 for the second. The airline has also overhauled its open seating policy and debuted basic economy tickets over the past year. And a record-breaking weekend at the box office, Disney's remake of Lilo & Stitch led domestic ticket sales, with the latest installment of the Mission Impossible franchise coming in second. According to box office tracker ComScore, domestic ticket sales totaled over $326 million for the long weekend. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, global bonds bouncing back.
If you have a perception as a debt issuer that the long end of the curve is not popular and the depth of demand isn't there, why waste money by borrowing expensive money? It just makes sense to me not to keep on trying to sell bonds that people don't want.
The long end is popular this morning. We'll talk about why in just a moment. Gennady Goldberg of TD Securities joins us next. Live from New York City, you're watching Bloomberg TV.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Coming off the back of the biggest one-week loss on the S&P 500 since Liberation Day week at the start of April. We're bouncing back this morning by 1.5% following a 4-day slide on the S&P. On the Nasdaq 100 higher by 1.6%. In the bond market, 10-year and 30-year bond yields up for a 4th week last week. Haven't seen that all year. This morning, waking up with lower yields, down 4 basis points on a 10-year, 4.47 on 30s, 4.97. 90. Under surveillance this morning, global bonds bouncing back.
If you have a perception as a debt issuer that the long end of the curve is not popular and the depth of demand isn't there, well, why waste money by borrowing expensive money? If you're a central bank, you tell your debt office, back us, we'll have inflation under control over the medium term, and these yields, these rates we have now won't last forever. It just makes sense to me not to keep on trying to sell bonds that people don't want.
So here's the latest this morning. Global bonds staging a comeback. Yields lower across Asia, Europe, and the United States as Japan looks to stabilize the bond market. Gennady Goldberg of TD Securities writing this. As market attention shifts back to softening economic data, we expect rates to move notably lower. Gennady joins us now for more. Gennady, good morning. Good to see you.
Thanks for having me.
This rally, as you know, born out of Tokyo, Japan. Overnight, the Ministry of Finance focused on supply and maybe thinking about tweaking issuance. How powerful would that be for the global bond market?
It's a pretty good warning signal. I mean, I think it tells you not only is the MOF looking at potentially changing issuance patterns, other treasuries could be as well. You know, you could see the same thing come out of the UK. You could see Scott Bessent actually notably say that, you know, the Treasury is considering lowering 20 and 30-year auction sizes, and that would really decrease the pressure on the long end. And that would kind of fly in the face of this almost inevitable, you know, pressure that we keep seeing over the last couple of months that rates must go higher because term premium must go higher.
Kit Juice of SocGen, just in that clip there, put it well. Why issue bonds that people don't want? Maybe we should start there. Why don't people want them? What is going on at the long end of the curve that investors just don't like?
Well, I think there's a lot of supply, first of all. I think, you know, deficits globally are going higher. You are seeing global central banks raise interest rates overall. What you're seeing is, it's not that people don't want them, it's that people want more compensation for holding them. It's term premium that's rising. What people also forget is that once you see economic data start to move around, that tends to drive bond markets more than supply. I would say it's about 90-10, 90% macro, 10% of supply. And right now, the focus is almost exclusively on that 10%. If you see economic data start to soften a little bit over the course of the next couple of months, you could see rates move materially lower, even as term premium stays higher. So that premium is going to stay high, but rates overall could shift a bit lower as well.
So just to sort of walk us through and build on that in terms of how you're actually investing, are you going into longer duration bonds with the expectation that the economic data will roll over and that there will be issuance management by treasuries around the world?
Well, so I think you can see some issuance management. I think the 20 and 30-year are particularly subject to it. You could see Scott Bessent announce that the Treasury's considering, for example, reducing 20 and 30-year auction issuance and issuing more bills over the next couple of years. I think the 10-year is a particularly interesting point. I think the 10-year is always in demand, and there's a lot of clients that I've spoken to who are considering these levels as particularly interesting. The issue is everyone's kind of worried about all of the supply, all these deficits coming to market. If there's a little bit of reassurance from the powers that be that maybe there won't be quite as much supply in the long end, they would feel more comfortable actually allocating cash to that part of the curve.
Okay, I find it really interesting that you talked about the 10-year and not the 30-year. Nobody wants to buy the 30-year.
No.
We have asked so many people, do you want to buy the 30-year here? Not one person. John, has one person come on the show and said, yes, I want the 30-year. I think it's very attractive.
Priya Misra called it a risk asset. Is it a risk asset?
Oh, absolutely. I think right now it's a risk asset because no one's quite sure where the bounds are. You haven't seen Secretary Bessent step up and try to defend 30-year or the 20-year rates. You've seen him talk about a little bit more in terms of buybacks. You haven't really seen them shift towards what I think is the more powerful tool is actually decreasing that long end supply. That would reassure people that perhaps there is a line in the sand. And that would, I think, get a lot of people taking a bit of a risk.
Do these forces force corrective action down in Washington, given the bill that's going through Congress at the moment?
I think right now, any sort of corrective action is tough to see. You're not really seeing a lot of fiscal conservatism. You're seeing a lot of the right messaging out of the Senate at the moment, but you're not really seeing that be pervasive. I think, unfortunately, right now, if there is an impediment down in Capitol Hill, the solution is to spend more, not spend less. So until we see some sort of, whether it's a bond market crisis or something like that, I don't really think Congress is going to be looking to actually decrease supply materially. But Treasury could, by issuing more bills and really taking some pressure off that long end of the curve.
At what point is this bill stimulative in a way that will keep the economic data from turning and actually causing that rally in the bond market like you're expecting?
I mean, the issue with the kind of the stimulative part of it is that a lot of this is tax breaks for some of the population, not all the population, while at the same time, trade policy is still quite a problem for most folks. So you're seeing kind of a twofold market. One is you're seeing higher tariffs effectively right at the start, and then you're seeing some relief later, and it's unclear what that policy lag is going to be. So my worry is that by the time those tax cuts actually come about, you may already see data weakening as investors have pulled forward purchases and they're not really, in the mood to continue to spend money.
When do you need to start seeing the hard data weaken to believe that that actually is what's going to happen? Because a lot of people have been saying this is distorted data. You can't actually depend on it. When can we get a clean read?
I think in the next couple of months. What we've been seeing in the last month or two is pulling forward, right? So investors have been buying up iPhones and all sort of capital goods in anticipation of higher prices. What you're going to see in the next couple of months is kind of the hangover from that. How much should they pull forward from Q3, Q4? I think in the next few months, you are going to see some of the hard data start to moderate. You may even see soft data recover, but maybe not to the levels that you saw before all this uncertainty started. So we're going to kind of converge in the middle. We're looking for 10-year at 4% by the end of the year. We're not looking for a recession. We're looking for a bit of a growth slowdown to remind markets that this isn't kind of all boom all the time. You are going to see rates come down a little bit as the data starts to moderate.
10-year takes a step down to 4, about 4.46 right now. Where's the Fed in that world?
We've got 2 Fed rate cuts penciled in for this year, one in October, one for December. By that point, you should see the inflation pass-through stabilize. You should see inflation actually top out around 3.7, 3.8% year on year. The Fed should see that is indeed transitory, shall we say, and then actually feel a little bit more comfortable coming in.
How they'll know?
We're going to see on a month-to-month basis, 0.5s, 0.6s, maybe even 0.7s for a couple of months. Given that this is probably going to be kind of a one-off type of transmission, by the time you get to really August and September, you should be starting to see that moderate. And if that's the case, they'll see that one-time shock, and they'll feel a little bit better about actually taking rates lower if the growth data starts to moderate.
You sound pretty constructive, particularly on 10-year bonds. Why then did you raise your forecast recently for 10-year Treasury yields by year-end to be 4% rather than 3.3% previously?
Look, the environment keeps changing. You know, we continue to keep abreast of new developments all the time. We saw a pretty significant, I would say, de-escalation in trade policy. Or at least right now, I would call it a bit of a détente. If that persists, I think that's the way we play it. If there's more uncertainty in play, rates could certainly be biased to the downside. I think the issue is right now, we're really waiting and hinging on what the administration does with trade. And if trade is resolved in a kind of I would say, in a peaceful way, you will continue to see rates elevated. If trade continues to cause more uncertainty and more problems, where it poses more downside growth risks, then you could see rates actually move a bit lower.
But you believe the higher the tariff, the lower the yield?
I think there's a certain point where, you know, as you get tariffs really, really high, then of course, you know, that's going to be kind of a disruptive influence on consumers and on the bond market as well. It is a bit of a, you know, it is a bit of a game, unfortunately, at this point, where you see investors really reacting to whatever the news of the day is. It's really hard for a lot of investors to capital plan. Both businesses, consumers, and investors, all of us are struggling because we're basically forced to digest whatever the overnight headlines are in anticipation of the investment priorities.
It's basically 2025. Welcome to 2025. It's an ongoing situation. Gennady, it's good to see you, as always. Gennady Goldberg of TD Securities. We flip from tariffs to taxes, back to tariffs again. There'll be a price to pay for that kind of volatility, and we'll get a sense of that, I imagine, in the next several months.
You know, when I talk to corporate executives, some of them say, look, we've got to keep up our plans because we can't move on a dime the way that the president's policies shift on a day-to-day basis. On the margins, though, why would you do that extra plan? Why would you go for that incredible investment expansion? Mergers and acquisitions, especially larger ones, have been put on hold. That's the kind of stuff people are watching to really understand how open capital markets are to ambition at a time of a lot of uncertainty.
It's really hard to commit if you don't know the rules of the game, that's for sure. Up next on the program, Judy Beale of Kane Anderson Rudnick, the NYSE president, Lynn Martin, Stephanie Roth of Wolfe Research, and Amanda Lynham of BlackRock. With equity futures bouncing back this Tuesday morning, equity futures up by 1.5%, live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance is up next.
We're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
We're back to tariffs on.
Of all the countries who are lining up for a deal with the United States, the European Union is going to have the hardest time.
We're also waiting for just more clarity around what the tariff policies will eventually look like.
We've seen our commentary change, not just week to week, but day to day.
Tariffs, we are still waiting to see the actual effects of tariffs, both on earnings and on the economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The commentary changes from hour to hour, never mind day to day. Live from New York City this morning. Good morning. The third hour of Bloomberg Surveillance starts right now, and your week ahead is shaping up as follows. On the earnings front, NVIDIA just around the corner. That drops tomorrow. On the Federal Reserve, FOMC minutes as well. On the labor market on Thursday, jobless claims. On Friday, a read on inflation, PCE, and the UMich Consumer Confidence Survey as read on sentiment going into the weekend. Before we get to all of that, here's the price action right here, right now. Equity futures on the S&P bouncing back by 1.4% as the president extends the tariff deadline for the Europeans. In the bond market, some support coming from Tokyo, Japan. Some support offering a rally in the bond market in Japan, in Europe, in the US as well. Yields down around the world.
The Ministry of Finance over in Japan considering reducing long-term bond issuance in response to the surge in long-term bonds that we have seen over the past couple of months. And this comes ahead of their 40-year auction, which is tomorrow. It also comes ahead of a slew of auctions in the United States throughout the week. You didn't mention those in the week ahead, but people will be watching those to understand not necessarily the 2-year auction today or the 5-year auction tomorrow, but the 7-year auction on Thursday should get interesting given some of what we've seen.
Heavy slate of supply coming worldwide, and it's important because it comes at a time when we're pushing this bill through Congress, pushing a bill through Congress which is pushing some pressure on the bond market, and maybe some of that pressure can be alleviated by the Japanese officials. The Secretary of the Treasury, Scott Bessent, needs a helping hand from the Ministry of Finance in Japan.
And Scott Bessent's been talking about how it very much is a global market. We were just talking to Gennady Goldberg about what drives the bond market. I think it's important to go back to first principles and try to understand this. He said it's about 10% supply. It's about 90% economic data. We haven't seen the economic data turn, so it's all really being driven by the supply story. It really goes to the show that if the economic data turns, all of a sudden we'll forget about the supply, and that really will turn back to just what is the state of the economy and what is the risk reward in risk-free assets, I put in quotes because we can debate that all year, and we have been in terms of bonds versus stocks, which have been something of the hedge against inflation and some of these concerns with deficits.
In very simple terms, that is the ultimate test for the bond market. The definition, for me at least, of what a developed bond market actually is. When things go wrong, do people buy the debt or sell the debt? When things go wrong, will you buy treasuries? Gennady Goldberg at TD is making the argument that if things go wrong, the data worsens, people will buy bonds. yields will drop, and he sees us going back to 4% sometime soon on a 10-year.
And he believed, as you pointed out, that the higher tariffs go, the lower bond yields ultimately go, because the more pain will be inflicted on the overall economy. That's going to be the test, right? And it really depends on what other narratives are competing at that moment with that weaker economic data. If there is inflation, if the supply doesn't change, there still is a lot of long-term issuance.
Bonds this morning doing better. At the long end of the curve, we're down 5 or 6 basis points on 30s to 498. On 10s, we're down by 4 basis points to 447. Coming up this hour, we'll catch up with Julie Bill of Kane Anderson Rudnick. With stocks looking to snap a 4-day losing streak, the president of the New York Stock Exchange, Lynn Martin, on weathering market volatility, and Stephanie Roth of Wolfe Research on risks facing the U.S. economy. We begin this hour with bonds rallying and stocks bouncing back. Julie Bill of Kane Anderson Rudnick writing the following: the market's attention has shifted from tariffs to rates, which makes sense, but we need to recognize some of the damage done to the system. Julie joins us now for more. Julie, welcome back. It's been too long. It's good to see you. Let's talk about that. The narrative flipping back and forth. What's the price to pay for the policy volatility of the previous 2 months?
Well, I think, the damage has really been done in terms of supply chains. And, we're all supply chain experts post-COVID, right? We all know everything about it. But if you look at port volumes, which are easy to track, you can see that there is so much volatility. It looks like a snake that's eaten all kinds of things. And the thing is that creates a ton of efficiency. You literally have companies that aren't even taking delivery of goods because they're waiting to see where tariff rates are. So it's a whole lot of energy and noise for nothing, right? For what used to be very smooth, efficient markets. And so my concern is that no matter what, when you create this level of difficulty in logistics, you raise prices, right? It's just the costs have to go up.
So, Julie, do you see any of that in the data? We don't see it at the surface level in the hard data. Do you see it in the company margins? As we exit earnings season, is any of this pressure starting to show up?
So I think, the thing that's really tricky for us right now is that if we think about valuations where we are, we're still at a pretty high level, and that makes sense to me because we have peak margins, right? And post-earnings, we're probably down 30 basis points from our peak of, mid-17s. So it's not, dramatic, but you are hearing companies saying, we have higher costs, we have some concerns about that. And I think you've seen so many companies that have just pulled guidance entirely because they just can't predict where they're going to end up, neither on the demand side nor on the cost side. And so that creates a certain amount of friction for us and concern because so much of these higher valuations in the US are held up by higher margins and profitability that we enjoy here that the rest of the world is kind of in envy of.
That said, Julie, and this is something we've been talking about throughout the morning, we've been discussing the potential headwinds to U.S. growth, and yet if you want to bet on tech, you've got to come to the United States based on the composition of the index, and that's basically been the reason why people say the premium will continue to exist, because where else are you going to get that concentration of the tech behemoths than the U.S. equity markets? How much of an argument is that for you?
I think that's an incredibly reasonable argument, and I would say that it's not even just technology, right? It's the depth of our consumer market. It's the depth of our research universities that support those technology markets, right? It's the dynamism of our labor markets that are the envy of Europe, right? You can't, you can say, all right, so, the US, it's not as shiny as it once was, right? But that doesn't change that we still have a real estate situation in China that's pretty difficult. So I think, yes, it's true. The shine on the penny is not quite as what it was, but still you have a really strong, dynamic, large market that's pretty important. And to me, all you have to look at is just the return on equity that our companies are able to generate. They're just higher than anywhere else in the world.
So given that kind of context, what are you looking for in NVIDIA's earnings tomorrow to give you the sense that there is more room to run in terms of the rally versus, wait a second, maybe we've overplayed how quick this AI adoption and revolution really is?
Yeah, I think understanding the depth of demand is really important, and more important than anything else, right? It's understanding how wide the demand is for them beyond the largest customers, right? We still have customer concentration concerns with this company. It's, for sure, the level of the technology surpasses anything else, and the switching costs of using that technology are high. But we have a lot of companies that are trying to switch out and make their own technology in these hyperscalers. So if the depth of demand goes beyond those hyperscalers, that makes us more confident that, there really is room to grow here. But again, you're really paying for both that growth and the ability to maintain and protect these margins. And so that's really kind of the question, is just the depth of demand and how many companies are continuing to seek out this technology.
Well, Julie, this is the issue, and this is a theme that's come up on this program before, and I'd love you to build on it. The biggest threat for NVIDIA could come from their biggest customers. Just how do you play that in financial markets in the years to come?
You know, I think that the real difficulty for them is they've made this decision to price at a very high level, and that invites competition, and it can be from their own customers who really have a lot of technical capabilities themselves. There isn't a ton of risk in the immediate near term, right? Because the thing that's so fantastic about their technology is the flexibility. And most of their competitors, that is, you know, Amazon and Google, are building ASIC chips that are going to be less flexible. If AI moves in a direction that requires more flexibility, that's going to favor NVIDIA. So I don't have a ton of concern from a competition standpoint. Where I have concern for NVIDIA is just the size and the depth of the market. To me, that's a bigger issue than whether or not they're going to be usurped.
I also am curious about what their commentary is going to be about some of the tariffs and some of the international backdrop, given that Jensen Huang was the one who had the hot seat, but also the great seat of being next to President Trump on this trip across the Middle East, even though Tim Cook seemed to be left on the sidelines wondering, what about us? How much does that give them an advantage, and what are you expecting to hear when it comes to trade, especially because a lot of companies have taken different tacks to differing results?
Yeah, I think it's really, really difficult, right? There is a risk of being seated next to President Trump in terms of the level of attention that you get, right? I think there's probably something in Tim Cook that wishes that he hadn't actually pursued this relationship quite as aggressively as he had, because the minute he's moving in directions that don't make the president happy, the minute he's going to be punished and called out specifically for having his own tariffs, your own private tariffs. Good for you, right? So I think that's a real challenge in terms of you would like to have the level of influence and support that the president can give you, but at the same time, if you make any action that moves counter to what his agenda will be, you will feel the wrath of it. So I think a lot of our big tech community are recognizing that they have to be a little bit thoughtful and a little bit strategic in how they deal with the president.
What's your strategic advice, not on how to deal with the president, but on how to deal with the dispersion within Mag 7, Judy, that comes about because of some of these issues?
You know, I think that the real thing is that it's multi-layered, right? It's really complex. All of these companies, we talk about them like they're a monolith, right? But their ability to leverage AI is very different among themselves, right? There's nothing really in Facebook's business model that requires AI to work. For Google, it's existential. It's their very essence and their right to maintain this quasi-monopoly on search. If it gets usurped by AI, which it really looks like it might, that's existential for them. And I think that's why the multiples are what they are for those two companies. The real question is, to me, is whether Apple is going to do what it kind of always does, which is be a fast follower, because its first forays into AI have not been great. I don't know about those text summaries, but I don't know a single person that enjoys them.
Julie, it's good to have you back on the program. We'll do it again soon. Julie Beal there of Kane Anderson Rudnick. Here. On the last point, right?
Yeah, well, I mean, look, all I can say is Siri wasn't fantastic. The AI adoption we've seen so far. Yeah, you know, the only thing is my mother's name is close to Siri, so every time I say her name, my phone starts to get really excited. So
you switched it off?
Yeah, it just gets really excited. I actually haven't switched it off. I probably should.
That was just put a different name in for your mum.
That's true. That's probably wise. You know.
See what happens.
Okay, thank you for the advice.
You pick the name, though. Apple is up by 1.7% this morning. Something nice, obviously. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. European auto sales dipped significantly in the month of April, with none feeling the brunt more than Tesla. Sales of the EV maker fell by roughly half in the month, totaling just over 7,000 units as it continues to lose market share. At the same time, Chinese EV maker BYD outsold Teslas in the continent for the first time. HSBC cut more than 24 analysts, and those affected include Stephen Major, a frequent guest on our network. That's according to sources who tell us here at Bloomberg it was part of a sweeping restructuring of its investment banking unit. The restructuring, led by CEO George El-Hedary, is expected to lead to $1.8 billion in charges over the next 2 years. And in sports, the Oklahoma City Thunder are 1 win away from the NBA Finals after beating the Minnesota Timberwolves in Game 4 of the Western Finals. League MVP Shai Gilgeous-Alexander and first-time All-Star Jalen Williams combined for 74 points. Playoff action continues tonight with the Knicks and Pacers playing Game 4 in Indianapolis. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the programme, the Morning Calls, plus we'll catch up with the NYSE President, Lynn Martin, in just a moment. From New York City this morning, good morning to you all. This is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Yep, in about 1 hour and 14 minutes away. Equity futures on the S&P bouncing back by 1.4%. Lower into the weekend, down for 4 consecutive days. Down off the back of the president's social media posts, ramping up the pressure on the Europeans, and then taking it back over the weekend, and we snap back. That's basically the story in equities.
Yeah, I mean, Ursula von der Leyen asked for an extension, and he gave it to her. And so that's that. And that seems to be what's giving everyone a lot of excitement.
Last week, stocks down, bonds down, yields up. This morning, stocks up, bonds up, yields down. Yields down by 4 basis points. On 10s, down by 6. On 30s. That correlation sticks. Equities and bonds are still moving in lockstep.
You know, what's interesting to me is it's not because of necessarily trade becoming less tense than it was on Friday. This is because of issuance plans, potentially, by Japan. What stories are going to stick? A, trade uncertainty. We're not going to resolve this in the next couple of weeks. And B, the idea of treasuries around the world being able to adjust their issuance in response to some of the questions around the long end of the yield curve. Those two stories, I think, are going to stick, and people are trying to plan around those because that is something you can hang your hat on.
I imagine the Treasury Secretary, Scott Bessent, is waking up this morning with a bit of a smile. I'm not saying that these are part of discussions, negotiations over trade, but I'm sure this is welcome news for the US and the Treasury specifically.
And it underscores what he has said before, which is this is a global bond market, and stop looking at us and blaming us for everything. Go look at Japan.
Blame Tokyo. Yields are down this morning by 4 basis points. That's the price action. Don't blame Tokyo for everything. It's a wonderful place. Time now for the morning calls. First up, Raymond James lowering its price target on Abercrombie & Fitch to 90, saying channel checks now show lingering softness at its flagship brand. That stock is up by more than 1%. Your second call from Guggenheim, lowering its price target on Target to 115, citing an uncertain outlook following the company's earnings. That name is bouncing back still by about 1%. And finally, Jefferies upgrading Southwest to hold, expecting shares to benefit after a string of strategy changes. That stock is up by 2.6%. Paying for luggage apparently is a strategy change.
Yeah, the strategy change is to basically make people pay for less. I mean, honestly, Southwest has also been trying to shift more into the more expensive part of the cabin. But again, I just wonder how much they could do
Just imagine the boarding chaos now, because no one wants to pay to put it in the hold.
You know,
Everyone wants to put it over in the overhead bins.
I saw a new one that they weren't allowing people on once the overhead bins were completely full. They said, if you still have your suitcase and it doesn't fit, take the next plane.
I call them bag Nazis at the front gate. You know the gate before you board? And they spot the suit.
Yeah.
And they want to shove the suit into the bag.
That made a big impression on you, didn't it?
Drives me insane. I watched them do it to John Hamm, you know.
Really?
Yeah. He came on the plane, rightly a bit annoyed, and then they came up to him because he was a bit annoyed, and do you know what they offered to do? Hang his suit up. So do you know what he had to do? Take it back
out of the bag.
Come on.
All wrinkled.
The people on the plane get it. They're like, can I hang up your suit jacket? But boarding the plane, they're like, no, you've got to put that in your bag. Make sense of that.
Let's have somebody call in. Please call in if you're a gate agent and you have personal thoughts about this, and you can respond.
We'll do this another time. Let's turn to the IPO market. Mountain and Hinge Health making strong trading debuts on the NYSE last week, both pricing at the top of their ranges and seeing strong demand despite ongoing uncertainty around tariffs and consumer health. Joining us now, the president of the New York Stock Exchange, Lynn Martin. Lynn, it's good to see you.
Great to be here.
Before we get to these trading debuts and maybe some IPOs coming through, I just want to talk to you about the amount of volume that's come through your business through the year so far. Just walk us through it.
Yeah, if I look back on this year, it's been a year unlike any other, both from the demands on our system and the liquidity in our system manifesting itself in trading volumes. Now, if you look at that period between Liberation Day and the pause, we saw records in terms of messaging traffic, hitting around 1.2 trillion incoming order messages that we processed with 30 microseconds median response time on 2 of those days. And then if you look at the amount of transactions that occurred on our platform and the equity markets as a whole, I mean, an average day is around 16 billion trades. And now, during that period, we had 30 billion. It's just unprecedented. It's more than 2 times the amount of volume, both from execution, from actual trades, as well as from messaging, than we saw during COVID. Now, you remember how active COVID was. And there's been a variety of reasons why we've seen that, I think.
Do you think it's something we take for granted? The infrastructure holding up in the way it has done?
I think it's something that we at the NYSE spend a tremendous amount of time thinking about and planning for. We hope you take it for granted because that means we're doing our job. Our job is to ensure that the markets are open and efficient so you can manage risk, particularly during those incredibly uncertain times like we saw in April.
We saw an incredible amount of volume on the secondary markets of existing companies that have existing shares. This was supposed to be the year of IPOs, of deals, of all sorts of capital markets activity. Where are we in that? Are we seeing a revival of that as people get a little bit more confidence around trade, or is it still really kind of being iced?
Yeah, so initially this year when I was with you both in Davos, I was incredibly excited. You know, I still am really excited about the IPO markets. I think Mountain and Hinge last week going and doing so incredibly well, both pricing at the high end of the range, both up significantly over their IPO prices just in their first 2 days of trading, are the sign of what I was talking about with you both in Davos, and that there's a tremendous amount of demand for new issuance in the market. Portfolio managers I talk to, long-only funds I talk to, they want new issues in the market. So I think you're starting to see these companies now come to market now that the VIX has come back to earth, come back to that 20-ish level, and you're not seeing as much of the intraday swings as a result.
You talked about Davos. I'm just wondering, the enthusiasm you had then, can you give a sense of how much lower the volume of IPOs or deals you expect to be for the remainder of this year now than, say, in January, based on the uncertainty and based on what hasn't gotten done over the first half of the year?
I'm actually still optimistic that the same amount of IPOs will go. It's just shifted out. If I look in the case of Mountain and Hinge, they were targeting early April. You've seen StubHub flip. You've seen Klarna flip. Circle went on the road this morning, which is an IPO we're incredibly excited about happening just next week. So I think you're starting to see that group of companies that was public market ready get out of the gates. So I'm optimistic. I'm optimistic that the second half of this year is going to be when you start to see these bigger names come to market.
Do we need clarity on the policies in Washington first? And how disruptive has that been for your business? I remember the president on the stock exchange floor, alongside you.
Yeah.
This is not what we all expected. This has been chaotic for a lot of people. Do we need some clarity on those issues to see the Canada play out in the way that you expect?
So I think there's just been some uncertainty in the market. You can't argue that. If you're a good company, though, if you're a company that has made the plans to go public, which many have, they're public company ready, I think they can go in any market, particularly when you look at certain sectors. Crypto is certainly a sector where there's a lot of optimism still. Some companies are still trying to weigh the benefits or the issues associated with tariffs, and that's going to be a movable feast throughout the course of the year.
Everyone around this table is incredibly pro-America.
Yep.
You and I were on a panel together. You mentioned Davos, and we were talking about American exceptionalism. And then all of a sudden, people are talking about peak American exceptionalism and the rest of the world. Can we have a final word from you on that? The future of America and American exceptionalism?
There's nothing that beats our capital markets. There's no substitute for our capital markets. They're the deepest, most liquid in the world. They continue to be the envy of a world. The geopolitical situation, though, is a conversation. I think that's where I'll leave it.
That's a diplomatic way of putting it. Lynn, it's good to see you.
Good to see you,
Thanks
too.
for being here. Lynn Martin there, the president of the New York Stock Exchange.
I love it. That's a new one that a lot of companies can put into their portfolio of words to describe this environment. A conversation, macroeconomic uncertainty. We should collect them and just give them as sort of a panoply of
Removing
options.
guidance because of the conversation taking place between the US and the rest of the world.
Because there's a conversation that's going on right now.
Up next, Stephanie Roth of Wolfe Research, Amanda Lynham of BlackRock, looking ahead to a week full of economic data, Fed minutes, and earnings from NVIDIA. We'll get the outlook from them in just a moment. The opening bell 1 hour and 4 minutes away. Equity futures here near session highs, positive by 1.4%. Live from New York, you're watching Bloomberg TV.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The opening bounce just around the corner, 60 minutes away. Equity futures on the S&P positive here by 1.3%. Following a 4-day slide, we're bouncing back here across the board with less than 1 hour until the cash open. Here are your morning movers with Danny Berger. Hey, Danny.
Hey, John. A lot to the upside this morning. Risk appetite is on. Tech seems to be leading at AMD up 3%. A little bit of sell side action too, Frank Lee over at HSBC, upgrading the stock from a hold to reduce, saying that the deal with Saudi after Trump's trip to the Middle East does indeed put AMD in an attractive position. Also thinks that it can continue to outperform Intel. Now, I've been talking about this deal all this morning. Salesforce buying Informatica. It is finally official. Salesforce issuing a press release in the past hour saying that it would do this in an $8 billion deal. That means that Informatica priced at $25 a share. We are just below that this morning, up 5.6%. It's a deal that they had pursued at the end of last year. It fell apart, and that deal has been revived. Now, finally, John, you were talking about this earlier, but Southwest Airlines getting an upgrade from Jeffrey, those shares up 2.5%. You mentioned the new business model, but we also now have some reporting from the Wall Street Journal over the weekend as to just how much your checked bag will cost when it begins this week. $35 for your first bag, $45 for your second, and unfortunately, John, I do think that includes your suit bags.
There you go. Chaos potentially there. Danny, thank you. It's the boarding process that's the most disruptive part of flying right now, like by far.
Basically, you have to bring your bag onto the plane or else you've got to pay $35.
So what's everyone going to do?
You're going to get on the plane first, which means people are pushing each other out of the way. Gate lights start getting involved. It becomes this real kind of crush.
Just explain what gate lights are, just so, you know, in case people don't quite understand that.
It was a term to people who are, say, in boarding zone 6. But when boarding zone 2 is called, they come up, and then when they scan their passes, it goes beep to try to shame them into not doing that.
There's certain flights I get on where everyone pretends they're Group 1.
Yeah, where?
Which tells me a lot about like the country that I'm going to as well. I love that. Yeah. Everyone's Group 1, I'm Group 1. But they're not Group 1.
Feel good about yourself.
You know,
do they get beeped?
Yes.
But do they get beeped?
No, they just walk straight onto the plane. I think some people sort of carry themselves as if they are Group 1, and they, you know, no one stops them.
Yeah, but then you end up with the crush.
Anyway, they need to fix that. We've got some economic data for you this morning and the week ahead. Let's get over to Bloomberg's Michael McKee with more. Good morning, Mike.
Good morning. Durable goods orders this morning. We're keeping track of what businesses are spending to see how they've been affected by the tariffs. And they have been affected, although the headline number, down 6.3%, is really a Boeing story, as it almost always is. Boeing orders down 51% during the month of April. The computers and electronic products, computers and related products, communications equipment, all this stuff that we get from Asia, down on the month. So capital goods orders, non-defense ex-air, down 1.3% after rising by 0.3% the month before. So it looks like we are seeing something of a pullback in business spending as they get ready for tariffs. We get a lot more data the rest of today and tomorrow. Consumer confidence at 10 o'clock. This is the conference board version. We'll see if people are as unhappy in that as they are in the Michigan numbers. John Williams is speaking today at the Bank of Tokyo, at the Bank of Japan, rather, in Tokyo, and he's going to give us some idea of where he is. Fed minutes tomorrow. What were they saying at the last meeting about what they saw in terms of the tariff impacts? Jobless claims on Thursday. Might be a little early still, but according to a lot of Fed officials I've talked to, jobless claims are going to be one of the things they're following most closely. And then Friday, they are following PCE very closely. What's inflation doing there? So suggested it will slow down, but we also get income and spending and trade numbers. So Friday is a big day. And then, of course, we've got a big interview coming up at 9:30 this morning with Tom Barkin of the Richmond Fed.
Looking forward to that, Mike. We'll come back to you on that interview and some of the Fed speak in just a moment, so stay close. Michael McKee there on the economic data. So jobless claims on Thursday. The following Friday, payrolls. The May payrolls report is just around the corner. Stephanie Roth of Wolf Research expecting the start of a downtrend, writing immigration will start draining labor supply, tightening the labor market. We might see an unusual environment with payrolls under 100K, but a steady or even lower unemployment rate. Stephanie joins us now for more. Stephanie, good morning.
Good morning.
Let's build on that. Where's wage growth if those two things are taking place?
That means we have a slightly tighter labor market at the lower end. So the payroll gains could shift below 100,000, but that doesn't mean the economy is weakening. It's the foreign-born workers, which were driving the labor force in the past couple of years and driving employment gains in a big way, are going to be going the other way. So that just tells us that we have a much slower, steady state of growth of payrolls, but we might be tightening the labor market to some extent because we have potentially up to 100,000 people per month that are falling out of the labor force from this foreign-born population.
So if we get that negative supply shock, does it lead to higher prices, higher wages?
Wages haven't been a big driver of inflation, sure, modestly so. I wouldn't expect that to be the bigger driver. The bigger driver is, of course, going to be tariffs, which will probably show up over the summer, and I don't know if the market's expecting that at this point.
So what do you do with that? Is that a good thing if the unemployment rate drops, even if you don't have a lot of job creation, or is that a bad thing?
I think it's just a new reality that the market has to get accustomed to. So to the extent that we might have some negative market reaction to a lower payrolls print or two, that may play out. But I think it's just a function of the Fed having trouble cutting this year because we're going to see an environment where the unemployment rate is steady to potentially even slightly lower. In an environment where inflation is higher, that's not a recipe for cuts in the back half of this year.
Are you basically saying that we can just expect lower employment creation for the foreseeable future, and that can be okay? It might be less mobility when it comes to jobs, but it isn't the world falling off a cliff, and that isn't necessarily a harbinger of a real weakening in the economic data later this year.
I think that's exactly it. Is we should just get accustomed to payroll gains running at a slower pace, but that's not a scary thing. It could be an environment where claims are still steady, and it's just a sort of a new reality where immigration is going the other way. And it's just a slower trend of payrolls growth, and it's not necessarily a scary thing, although perhaps the market just has to get accustomed to it.
So what is the new 200K, the new 180? What's the number we should get accustomed to?
The new 95.
The new 95. Comfortable with 95. And unemployment with 95 might actually be lower, not higher.
That's correct.
Where does that leave the Fed?
That keeps the Fed on hold for a lot of this year. How are they going to cut in that environment?
You've got 0 cuts for 25.
I think that's the direction of travel. It's hard to envision an environment where the unemployment rate is steady to slightly slower, job growth is at an okay pace, and we're not seeing claims rise. How's the Fed going to cut in that environment when inflation is running above 3%?
You think it stays above 3% for the remainder of the year?
I think there's a very good chance of that.
That's hot inflation. Can we call that hot inflation?
Yeah, I mean, we're not going to use the word transitory, but like that's the concept, sure. But yes, it's hot inflation.
Around where the Fed will be. You've got the New York Fed President John Williams speaking a little bit later in Tokyo, Japan. He said we might not be able to make a move until at least September. That's what he's indicated. But what I hear from Stephanie is that they're going to be on hold for quite a while, looking at 3% inflation and unemployment that's not climbing, that might actually be falling.
So I'm looking right now at the commentary that we got from Neil Kashkari over in Japan. And the reason why they're in Japan, by the way, because I did some research, is because the Bank of Japan is holding their Institute for Monetary and Economic Studies conference. So that's the reason why they're over there. I just wonder if there sort of is a split right now on the Fed. With some numbers, I'm thinking of Chris Waller, who's talked about a sort of bias toward cutting rates, shifting toward that kind of reality, and others saying, hold on a second, we're expecting what Stephanie Roth expects.
I mean, I think Chris Waller may also be sort of playing for the job as Fed chair, so that might be an element of that. But I think the bulk of the Fed will be moving towards a reality of let's just wait and see. And then as their growth forecasts potentially shift up throughout the course of this year, then they're going to be shifting towards the environment of perhaps we're not going to be cutting.
Why do you reject what so many people who come on this show says is happening, which is consumers are weakening, they're becoming more discretionary, they aren't necessarily buying big ticket items, you're starting to see cracks or on the margins among a number of different consumer demographics. Why do you not see that as percolating into fundamentally weaker data?
This has been the story for the past 2.5 years, and the economy's been okay. So it's been partially sure. There's been cracks at the lower end, but the bulk of the economy has been doing just fine from a consumer perspective. We've had healthy gains in equities, healthy gains in housing. That's not really gone away in a material way. Now, equity markets have done a bit of a round trip this year. The consumer's doing okay as long as they're employed. So I'm not worried about these significant cracks at the lower end really getting much bigger. Now it's just a backdrop of the consumer spending in line with their income growth. And by the way, on the travel side, as we were talking about earlier, perhaps some of the issues that we've had with flight safety has actually been weighing on travel sentiment for the past couple of months. And I think that might be one thing that was weighing on prices of travel. And we might see that reverse over the summer.
When Delta first came out and talked about the weakness in the middle of February, they did point to the aviation safety issues, not just the policies coming out of Washington, but some of those issues as well.
Sure, that's definitely a part. At the same time, you have seen international travel fall, and you do see ongoing questions around domestic travel at a time when certainly in the main cabin, I'm talking not the premium seats and the people who actually are in group 1 and 2.
And not pretending.
And not pretending, or maybe they are pretending because they're in the back of the cabin. I mean, you've seen those people really push back. So there are a lot of questions here about just how much hesitance there actually is.
The estimate for next Friday, by the way, is 130. That's down from 177. So using the Stephanie Roth adjustment, what's that? 210?
Yeah, that's a fantastic
like
number.
that.
Basically, we're all off to the races. Is that 220? Would you say
210, 220?
That sounds, yeah, but that sounds,
like that. All right.
that would be high.
All right, Stephanie, thank you. It's good to see you. Stephanie Roth there of Wolf Research on the economic data. A lot to look forward to. Mike McKee, including Mike McKee, the Federal Reserve speak we're going to get a little bit later. What are you looking for, and what have you heard so far?
Well, basically what we're hearing, John, is the same thing that everybody is telling you on set, that nobody knows what the Fed is going to do or when they're going to do it because nobody knows what the impact of the tariffs are. There is one interesting aspect to this all that just makes it even more confusing. You take a look at what's happened with equities and with bonds. And you had Lynn Martin on a little while ago talking about the volume and volatility she's seen. This is the S&P 500. That's the definition of some volatility when Trump says one thing and then changes his mind a couple days later. But there's one asset class that has not moved. It's the dollar. The dollar just keeps going down through all of this. And that is not particularly good news for the Fed, because when you impose tariffs, it means people buy less foreign goods, less demand for dollars. And at this point, the dollar should be going up, but it's not. And that's a confusing situation for the Fed. As long as the dollar keeps going down, it means that U.S. imports are going to be more expensive. And that's not, that's what the president wants to see, but that's not what the economy overall needs. There's not a lot of good explanations for this, but the one thing that people have been telling me as I've been traveling around the country these past few weeks is it may be just a sell the USA at this point. Not a lot of confidence in the United States. You can't get completely out of the dollar because it's too important, but there is concern about what's going on.
Mike McKee, thank you, sir. Concern for a lot of investors as well. Equities down, bond yields up. That's been a problem. Bond yields up, dollar weaker. That's been a problem too.
This sort of toxic brew of correlations breaking down has been something that people need to watch. There is this question with the dollar about whether it was just overvalued, though, coming into the year, and whether some of the correction that we've seen has really just been a virtue of that rather than truly sell America.
The DXY at 99 is not weak at all, to your point.
That's one of the theories out there, but it is so difficult. It is narrative roulette. We talk about that every morning. it's the conversation, as Lynn Martin said.
But FX is always relative, and relative to the start of the year, we're a whole lot weaker. 99.28 on DXY. Amanda Liner of BlackRock joins us around the table. Amanda, good to see you.
Good morning. Thank you for having me.
You've been focusing on the interplay between margins and the labor market. Let's get an update. Where are we now?
Yeah, I think Anil Kashkari said it well to your colleagues over in Asia. Their time is of the essence here. Companies are in a bit of a wait-and-see mode. This is something that's been coming up in our client conversations over the past few weeks, including some conferences. Corporates are signaling that they're in a wait-and-see mode, but there's an expiration date on that wait-and-see, and I think that's really what we're focusing on. This really just hinges on the labor market. You heard Stephanie say consumers can spend so long as their employment situation is solid. It's really that interplay between margins and the layoff rate that I think is going to determine the path from here.
So when's the expiration date?
Well, I think the Fed is almost laying the groundwork for focusing the market on September and even going forward from that. I think if we can get through the next earnings season, this earnings season I think positively surprised. If we can get through the next earnings season, I think that will provide some clarity. But I kind of take a step back. If I'm a corporate CFO, and I thought your conversation with Lynn Martin was great, at some point they just have to move on with it and go through kind of the strategic initiatives that they need to enact. So for example, we've actually seen strategic M&A rebound a bit. It wasn't that depressed to begin with, but I think corporates that are looking to do transactions to bolster their business are actually moving ahead with it. Where we've seen some lagging is on the private equity sponsor-related M&A, where financial economics are a bigger part of the equation. But I think to a certain extent, there's almost a level of optimism that no matter the path, corporates can manage through it. And to a certain extent, we're actually, I think, starting to see a bit more of that.
So if you talk to corporate executives, you get a sense of optimism. You get a sense that they're going to keep on going, that there's certain levels of demand that are just going to be sticky and that they can plan their business around that. Where the cracks are going to come is the consumer. That's what everyone has been saying. How much do you really believe in that, given that you see real contradictory types of data on that?
Yeah, and I think it's a great point. Sometimes folks describe it as mixed signals to us, but what I actually think is happening is that just like there's been dispersion in corporate credit, liquid, private, commercial real estate, there's also dispersion in the consumer. One of the things that's jumping out in the recent data is that those consumers with student loans, now that those are actually impacting their credit scores and the delinquencies, are coming under more pressure. So there's a bifurcation that has always existed amongst consumer income cohorts, but we believe in this cycle it matters more because the rate environment is really a forcing factor for affordability. So if you have floating rate exposures, you have high mortgage rates, these, I would say, differences in consumer strength are becoming more prominent in this cycle versus previous cycles. I think what we really need to focus on is, does that weakness that is so far confined to the low-end consumer extend more broadly up into the higher income consumer? We're not seeing it yet, but that doesn't mean that risk isn't out there. So we're finally attuned to kind of what does that labor market dynamic look like.
And if we see that migration, that certainly poses a threat to the headline data, that's for sure. I wanted to talk to you about the price of credit at the moment. We've had a lot of guests come on and talk about the riskiness of government debt, and hardly any talk about the riskiness of corporate credit. How are the two trading relative to each other at the moment?
Right. So I would say, let's use high yield as an example because it's a bit more growth sensitive. The tights for high yield spreads were 256 earlier in the summer. We're at 330. So we're not back to that kind of euphoric period of mid-February, but we're certainly well below the post-financial crisis average. So I think where there is for sure some room for spreads to widen. I think going back to your point, Lisa, though, there's almost a sense of front-footed behavior amongst investors as well, that they're cognizant of the fact that they cannot time these developments. I think what happened over the weekend is a great example. We left Friday, it seemed like a bit of a risk-off tone. We come in this morning, it's very risk-on. Corporates, just like investors, don't want to be on the sidelines. And so there's almost a kind of just move forward and kind of invest with the assumption that there will be some volatility from here.
Bank of America pointed out that some Microsoft credits, some maturities are trading through the treasuries. And I want to understand from your perspective whether you are seeing some investors begin to treat certain corporate credits as more safe than maybe the US Treasury, which sounds bizarre saying it out loud. Are you seeing that take place?
So I would say that part of the market, so when I started in corporate credit in 2005, there were actually a fair amount of AAA corporates left. There are really only 2 AAA corporates and then a handful of universities. That whole segment of the market is about $90 billion US, AAA rated corporates. It's very technical, it trades very tight. It also depends upon where are you on the curve, where your spread is getting calculated. So I wouldn't take that as an arbiter of this is a better credit than the US. I think what it is just the fact that over time, time, over the past 15 years, there's been a migration down in credit quality in the U.S. A lot of corporates are just happy to be BBB. They don't need to be AA or AAA anymore like they were in 2005. And I think that's really what you're seeing.
Is there a lesson also, though, about who the buyers are at any given time of the Treasury market versus the corporate debt market, that they're two distinct buyer bases with different metrics to understand when to come in and when not to?
Absolutely. I do think that there's a healthy amount of market segmentation that has been in place and remains in place between those two market cohorts. I really just think, though, if I'm an investor looking to deploy money in the corporate credit market, I see more scope for balance sheet deterioration amongst AAA and AA rated corporates in this environment than I do in BBBs. And you know our view. We like selectively moving down in credit quality. So for choice, I would prefer to be in the low end of investment grade, where I'm pretty sure those companies will want to stay investment grade.
To your point, though, is that by design, that deterioration? Is that because someone in the C-suite has said, we should do this?
And I think that actually the historical experience shows that your cost of capital as a AA-rated corporate isn't that much less expensive, or isn't that much cheaper than a BBB-rated corporate. And so I think over time there's been a steady migration. Now, I think corporates use that prudently. They're not going to lever up just to do a run-of-the-mill buyback. They'll wait for the right acquisition. They'll wait for the right time to add that debt to the capital structure. But that's been a long-term trend that's been in place for the past 10, 15 years. And I think actually those BBB corporates are just fine. And even some of those high end of high yield corporates are just fine as well.
Amanda Lynham of BlackRock, thank you. Good to see you. One way to put it might be, if you are AAA still, you lack imagination. Is that the way to put it?
Is that the way that we're spinning what happened with the United States?
Based on that conversation.
Credit rating? Look, debt is not a bad thing. If used correctly and prudently, it can be a positive
Precisely.
thing. And there's certain tax benefits that companies get from issuing debt also that makes it a lot cheaper than what it looks like on the headline level. If you have big, grand ideas, this is the country where you can borrow to engage in them
That's
and,
the spirit.
go for it.
Nice.
Don't be AAA and dowdy.
Amanda, this was good. Always a clinic. Thank you. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. Shares of Informatica are rising in the pre-market after Salesforce announced it was buying the company for $8 billion. Salesforce CEO Mark Benioff saying the deal will create the most complete agent-ready data platform in the industry. This will be one of Salesforce's biggest acquisitions ever, and it expects it to close early in its fiscal year 2027. Meanwhile, German Chancellor Friedrich Merz says Ukraine has been given permission to use weapons given by its allies to strike deep inside Russia. Ukrainian President Volodymyr Zelensky has long appealed for this authorization. And President Trump wants to cancel all federal funds directed to Harvard. The New York Times reporting the president will send a letter to agencies instructing them to end contracts totaling about $100 million with the university. The letter cites a pattern in which Harvard has shown a, quote, lack of commitment to non-discrimination and our national values and priorities. The saga continues. That's your Bloomberg Brief. John?
Indeed it does. Yahira, thank you. Thanks for this morning. Up next on the program, we'll set you up for the week ahead, live from New York City. You're watching Bloomberg TV.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Equities positive by 1.2% on the S&P. The open about 36 minutes away. As we count you down, the trading diary looks like this. At 8 p.m. Eastern Time, New York Fed President John Williams speaks in Tokyo. On Wednesday, Fed minutes plus NVIDIA earnings after the closing bell. Thursday, another round of jobless claims. And on Friday, a read on inflation, PCE, and UMich consumer sentiment. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, the fate of this market day today seems to be in the hands of one man. What's the schedule for that one man today?
Yeah, hey, John. Well, actually, President Trump doesn't have much on his public schedule today after what was the long Memorial Day weekend, but we are starting to look out for clues on whether or not there could be any sort of momentum when it comes to trade deals. We had NEC Director Kevin Hassett say in an interview earlier this morning, some could come this week. Of course, this echoes messaging that we've heard from the administration last week as well. But interestingly, John, he did say that we could see tariffs drop below 10% for some countries if they do come to the table with good enough deals. Of course, it had been our understanding that 10% really was that floor. Now, of course, it's one of the countries, the trading partners that we're watching closely here is the European Union, which we're not expecting to be resolved this week or get a tariff below 10%. And the stakes are high. John, Bloomberg Economics says that if that 50%.
Tyler Kendall with the latest in Washington. Can you imagine if someone gets below 10%, how the British might feel, the UK?
Jilted. A spot angry.
Oh, is that your accent?
I mean, I think I offended a lot of people.
Probably a good place to leave this program. All right. Look at that clock.
What did you think of that? You didn't like that?
That was like, you know, what was that Mary Poppins stuff? That was like Mary Poppins. Was that Dick Van Dyke?
That was my dumpling.
All right, coming up tomorrow. I'm moving on. David Leibovitz of JP Morgan Asset Management, Monica Guerri of Morgan Stanley, Gon Chrisman, French Hill of Arkansas, and Aaron Cannon of Clear Harbor Asset Management, live from New York. I don't know what that was. This was Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about over-regulation, frankly. And so as you look, what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows, up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Looking at a bit of a rebound today, 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
We are bouncing back. Wall Street is set for a post-holiday rebound on U.S.-EU trade talk optimism and seeking clarity. Richmond Fed President Tom Barkin joins Open Interest as officials wait to see where trade policy settles. Plus, this week's main event, the so-called godfather of AI, Jensen Huang, gets set to take the earnings spotlight. Katie, you're looking at NVIDIA.
Exactly. It's hard to look at anything else right now when you consider that we have earnings tomorrow, due tomorrow afternoon specifically. Dan Ives over at Wedbush saying that this is the most important stock of the moment. You can see NVIDIA shares up about 2.6% pre-market right now.
All right, so looking at some gains there, and that's really important, obviously, for any rebound. Also, a deal today. Salesforce will buy cloud software firm Informatica for $8 billion. That would be CRM's biggest acquisition since Slack in 2021.
We'll definitely get to the details of that deal, but stocks set to bounce back, as Matt mentioned, after President Trump postponed his June deadline for 50% tariffs on imports from the European Union after a call with Commission President Ursula von der Leyen.
We had a very nice call, and I agreed to move it. I believe June 9th would be, July 9th would be the date. That was the date she requested. Could we move it from June 1st to July 9th? And I agreed to do that, and that she said we will rapidly get together and see if we can work something out.
And the EU is now planning to fast-track trade talks with the U.S. by focusing on critical sectors and non-tariff barriers. Bloomberg Washington correspondent Tyler Kendall joins us now from the White House. So we're back to the original July deadline, but give us a little bit more detail on what critical sectors actually entail.
Yeah, hey, Katie. So these are the sectors that this White House has already subject to Section 232 investigations, like autos, steel and aluminum, pharmaceuticals, that's a really important one to watch, as well as chips. And it's our understanding that these discussions around these critical sectors are going to happen in parallel with the technical discussions around tariffs and non-tariff barriers alike that we know this White House really wants to focus in on, like, say, regulations. Now, this is considered to be a positive step, but but there is still a really long way to go here. And our reporting indicates that the European Union has felt that there hasn't really been much clarity out of this White House on exactly what needs to get done in order to clinch a deal. We know, for example, that the U.S. wants them to address these non-tariff barriers, also wants to see the European Union boost imports when it comes to agricultural products, as well as U.S. LNG. But keep in mind, last week, the White House outright rejected an updated proposal from the EU that would have seen both sides lowering their tariffs down to zeros on certain agricultural goods and industrial products. So we're going to have to watch to see how this shakes out because, Katie, this White House often says that it is difficult to negotiate with the European Union in part because it's negotiating as a bloc and all 27 member states ultimately need to come to an agreement.
Sounds like a helicopter is landing somewhere near you, Tyler. Maybe someone's coming back from trade talks. We heard Kevin Hassett on CNBC a few minutes ago saying that he expects more deals to come possibly this week. Which are the key deals that we're still waiting for?
Yeah, I mean, there's a bunch of them, Matt, and we should also caution that we did hear this similar messaging from the White House last week that there could be a new trade deal imminent. Now, he himself had highlighted India, a country that, of course, we know has been given priorities in these talks, and we're really waiting to see if there are any updates when it comes to these Asian economies that are geographically close to China, such as South Korea or Japan, in these discussions. We had also previously heard from Treasury Secretary Scott Bessent that they're looking to do this by region right by region, so perhaps they rolled out the UK and Europe. We could see one in Asia, but then also keep your eye on any movement when it comes to Latin America. That's one of the regions that Scott Bessent has previously highlighted.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there at the White House. Let's get now to the big corporate story, earnings story of the week, of the month, of the quarter. NVIDIA is finally coming out. An upbeat earnings report tomorrow could lead to a broader stock rally. Wedbush analyst Dan Ives says, quote, "There is no company in the world more important to the markets and global investor sentiment than NVIDIA." Let's discuss with Bloomberg Technology co-host Caroline Hyde, as well as Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh. Mandeep, let me first get your expectations for the numbers. Are we going to get an upbeat report?
I think so, and so far the data points that we have received, from the hyperscalers giving their CapEx guide, everyone has increased their sort of guide for CapEx this year, and the commentary they had around inferencing in terms of, more users using AI products that's resulted in more token usage. All that is positive for compute consumption. So the only negative is NVIDIA will lose China revenue because of the restrictions, but they did sign a few deals in the Middle East. So I feel net-net you will see upside. I mean, clearly market is fixated on what will happen to 2026 CapEx, and it's too early to say. So that's what I think we'll find out from the earnings call.
Well, it's a great point on CapEx. There was a really interesting Bloomberg Terminal story this morning about how across industries CapEx spending has been maintained. But let's talk a little bit more about the China relationship there and some of the numbers, because we've already heard from Jensen Huang saying that NVIDIA is set to lose $15 billion basically from those Trump administration licensing requirements for the H20 chip. But it's unclear when exactly we'll see that, whether it will be this report or subsequent reports.
Whether or not they write off the inventory, whether that hits margins in the here and now, as Bank of America have been signaling. Also, whether they manage to reorientate and find a sort of chip that they could eventually sell into China once again. I mean, this is a company that reorientates and reorientates so that it continue its relationship. Remember, Jensen Huang flew out to China just after those limitations to say how focused he is still on the business. But as Mandeep said, the Middle East is where we're expecting the forward-looking guidance to point. Was it 18,000 Blackwell chips are going to be going to Humane over in Saudi Arabia? Got Oracle saying how many they're going to be purchasing for some of the key data centers they're building, and of course a deal in the UAE. So I think the guidance is going to be super strong for demand, just whether or not they can curtail, well, they can swallow the hit to margins for China and indeed reorientate the business towards it.
Just on that point, UAE announced they will have nationwide access to ChatGPT. This came out over the weekend. So imagine if every country starts doing that in terms of giving, nationwide access to large language models. That's going to be insane in terms of demand uplift. So that's just one data point, but clearly it's kind of shows the potential when it comes to the demand side of the equation.
Let's talk about Apple for a moment, because they haven't been doing enough of this artificial intelligence, right?
Yes.
And those shares are down 22% year to date. they also have the looming threat of another 25% tariff from President Trump. What do we know?
I mean, they're actually signaled to bounce in trading today, but the Magnificent Seven, Apple is your worst performer. And as you say, they've all got a whole host of issues that are impacting the investor base right now, whether it be the fact that they're late to the AI party and they're having to depend on OpenAI, which is maker of ChatGPT, which is going to be managing to fulfill maybe UAE's desires to get into large language models. What is it? Are you going to be accessing it via your Apple Intelligence phone, or are you going to be relying on other Android applications instead? What's interesting is that Apple also has the issues of maybe it loses money on its apps going forward, or indeed the App Store, because of what the overall regulatory environment is happening in the United States. Whether or not, of course, we see a 25% hit in tariffs, would they swallow that on a margin perspective? Bloomberg Intelligence, I mean, Mandeep, you're thinking 300 to 350 basis point hit in the here and now.
Wow.
They have to swallow that 25% tariff.
By the way, Katie, while you were away last week,
yes,
I don't know if you saw, OpenAI is going to do a deal with Jimmy Ive. So we thought he was...
Johnny, right?
Johnny Ive, sorry.
See, I read the headline.
Yes. We thought he was going to be at some point developing hardware for Apple, but he never did. And now that looks like maybe a longer-term threat.
Yeah, that one reached me all the way out in Ireland because that is a big moment, I feel like. It's a big wake-up call. I saw it being phrased as. And I don't know, you add it all together for Apple, you actually have shares up a little bit pre-market right now, snapping an 8-day losing streak, Mandeep. That is the longest losing streak in about 3 years. And we're talking about that 25% tariff. And it seems like there's a lot of skepticism over whether that will materialize. But investors can't ignore the risk. And I feel like from where you're sitting, analysts can't ignore that risk either.
Yeah, no. And it will go into effect, although all the tariffs that have gone into effect have ended up, getting delayed for some reason because it's a negotiation tool for the administration. So in this case, my hunch is there will be some sort of negotiation, but look, if they have to absorb the tariffs, then they may have to raise the prices by 15 to 20%, and the math is very simple here. The costs go up by almost, $150 to $200 on a $1,000 phone, and the only way they can make up for that is by increasing the cost. I don't think they're going to absorb that.
And Katie, I don't know if it reached you in Ireland, but after the Apple Truth Social post, there was then the Samsung Truth Social, or at least question that was asked by the media to Trump. And he was like, maybe any foreign-made smartphone being shipped to the US. And actually, maybe that gives Apple in the longer term a bit of a competitive advantage versus an Android phone or a Samsung, because at least they have that scale of margin that they can negotiate with their suppliers and indeed perhaps up the phone price a little bit more than competitors.
That is such a good point that, it's almost ironic in a way that, if it were all foreign-made smartphones, that could actually end up helping Apple. You have what is this tiny little phone you've got here? That is an ancient specimen, an artifact, really. I'm never getting a new phone at this point.
It's, it's interesting that you resist. At some point, you're going to have to, right?
Now I can. I mean, I'm not price insensitive when it comes to...
But you saw Nikolai Tangen from Norway's Wealth Fund says if you don't use AI, you won't get a raise.
That actually missed me. That one didn't quite rise to my level.
Mandeep, let me ask you about Salesforce, CRM. Yeah. Dan Ives says, to quote the bullish tech analyst again, this is the right deal at the right time. $8 billion, what do you think?
I mean, companies are right now trying to make sense of the data that they have to customize the AI. We know the large language models have got a lot of cool capabilities, but if you're an enterprise, you're looking to make sense of your own data. And that's where it makes sense. Salesforce has the CRM distribution. They want to acquire a data company to help companies sort of make sense of their own data. I don't think they're overpaying in this case, but an $8 billion acquisition is sizable. And Salesforce does have a history of making, large deals. So MuleSoft was another acquisition they did around data. So Data Cloud actually was their fastest growing product in the last 12 months. It has a $900 million ARR. So clearly, data is where it makes sense for them to differentiate themselves. I don't think Salesforce wants to train their own large language model. So I think from that perspective, the rationale is clear.
All right, that's a good place to leave it. It's going to be a big week. We'll be seeing a lot of the both of you. Our thanks to Bloomberg Technologies' Caroline Hyde and Mandeep Singh of Bloomberg Intelligence. Now coming up, Victoria Fernandez of Crossmark says that Wall Street fears have shifted from downside growth risks to higher deficits and stickier inflation. We'll discuss with her next. And then later this hour, an exclusive interview with Richmond Fed President Tom Barkin. All that and more coming up. This is Open Interest.
flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%. And I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Let's get to high interest now. Look at what's making headlines around the world. The Trump administration is set to cancel the government's remaining federal contracts with Harvard University worth an estimated $100 million. It's the latest escalation in the battle between the U.S. government and the Ivy League school. Since last month, the administration has frozen about $3.2 billion in grants and contracts with the university. It's also tried to halt Harvard's ability to enroll international students, a move that Harvard's president said would be a devastating blow. Trump is also threatening to withhold funds, federal funds, from the state of California. In a post, the president says the governor is, quote, illegally allowing men to play in women's sports, and that's the driving force behind this new push. Private equity firms are seeing a sharp drop in fundraising this year. It's the latest sign of how a slowdown in deal-making and IPO offerings has hurt the industry. PE fundraising plunged 35% to $116 billion in the 3 months through March compared to the same period last year. The numbers paint a gloomy picture as investors weigh the impact of President Trump's tariff policies. And as Elon Musk pulls back from his political work in the government, he's turning his attention back to SpaceX. Later today, Musk will lead an all-hands live stream to discuss his goal of sending humans to Mars. Shortly afterwards, SpaceX will launch the 9th test flight of its Starship rocket. Starship is critical to Musk's vision as it's meant to serve as the primary spacecraft for transporting people to and from the Red Planet. Katie?
All right, well, back on planet Earth, Citi strategists say that bearish bets on U.S. equity futures increased last week. The team says that NASDAQ 100 and Russell 2000 saw a rise in short flows amid concerns around the fiscal deficit and global trade. Crossmark chief market strategist Victoria Fernandez says that last week was a turning point for these markets, writing that fears have shifted from fear of recession to those of deficits and higher inflation. Victoria Fernandez joins us now. So Victoria, it's a note that keeps being struck across the street, basically that there is this fear building over the deficits. You saw that in the bond markets last week. When do we start to see that in a bigger way in the equity market?
Yeah, well, I think a lot of it is just going to depend on what yields do going forward, Katie. I mean,
when we had the downgrade of the debt, I know many people anticipated we would see larger moves in the bond market than what we did, but it's kind of because they were the third person to the party, right? We already had that twice, but it brought it back to the forefront that deficits are an issue for us, that interest expense in this country is out of control. And you put on top of that the fact that we have Congress working on a tax bill, spending cuts, tax cuts. It really just brings it to the forefront once again. And I think it's going to be when bond vigilantes actually step in and say, wait a minute, we've had enough, no more of this, that's probably when you'll see yields move a little bit higher. And when they go north of that 4.5, 475 level on the 10-year, you're probably going to see the equity market respond.
We did have, we had the worst week for equities, Victoria, last week since April 2nd. We had 4 weeks in a row of increasing bond yields. We haven't seen that so far this year. But it looks like really Japan's move to cut longer end issuance is helping bond markets around the world, and that in turn is helping equity markets. Do you see it that way as well?
No, I absolutely do, Matt. And that's because the bond market is a global market for sure. And so you see global bond yields actually move together. So when we saw Japan talk about they're going to be decreasing that issuance following that really poor auction that they had, we saw the same thing in the U.S. We had a not great auction here. We saw yields move higher. And now today they're moving lower in accordance with what we're seeing out of Japan. But I don't think we're seeing significant moves at this point. We're down a few basis points, but I think that underlying concern of term premiums, the underlying concern of the deficits and stickier inflation is going to keep a floor under the longer end of the yield curve and give us steeper yield curves than what we've seen as of late.
It's interesting, this daisy chain across asset classes right now. You talk about that floor basically under the long end of the bond curve right now. Let's talk about how that translates into the equity market, because we're counting down to NVIDIA earnings tomorrow. You have the likes of Dan Ives saying that this is the most important company on Wall Street right now when it comes to sentiment. Talk to us about those cross currents, though, because you have what's going on in global bond markets. You have, of course, corporate America and the earnings picture there. And then you have the economic data that is still coming hot and heavy. What is the biggest driver right now, Victoria?
I would have said before, Katie, that we always look at the bond market and we look at spreads to tell us kind of what's happening. That's been your canary in the coal mine for quite a long period of time. That seems to have shifted over the last few months. And really, you've got the FX market that's driving a lot of what we're seeing. You've seen this kind of split between the dollar, what's happening with the dollar, and what's happening with 10-year and 30-year yields starting back in March, this divergence that we hadn't seen prior. So I'm not sure that we only have one element telling us what's going to happen, but I do think if you see spreads move wider, which we saw after April, right, the beginning of April, they've tightened back in a little bit. But if we see credit spreads start to move wider, that's going to give us a little clue as to what could be happening in earnings. We saw earnings expectations or seen them already come down for the second quarter. That obviously flows through to the equity market and concerns around profit margins and what they're going to be able to do in terms of pricing. Prices paid on the ISMs continue to move higher, so that's going to put pressure on those companies as well and flow through to the equity market. So a lot of different moving parts working together to kind of pull the picture together. And I think we'll just have to keep watch and see what the new headlines say around tariffs, around debt, and around spreads.
Hey, we're going to be speaking with Victoria, Tom Barkin of the Richmond Fed in just a few minutes. And I was just wondering, what do you want to know from him? What do markets want to know from this Fed?
I think everyone wants to know when the Fed thinks that they're going to be able to have clarity and make a decision. We heard from some Fed speakers, I want to say maybe it was Bostic last week, that said, look, it's going to take 3 to 6 months after we see clarity on tariffs for the Fed to have clarity in the moves they want to make. That puts us, say we get clarity on tariffs at the end of the first 90 days, which puts us, early July. That already puts us into October at the earliest for the Fed to make a decision. So it is pushing its hold time further and further out this year. And that's going to have to start getting priced out of the market more and more, which means yields, as we talked about a minute ago, will continue to go higher. So I would really like to know what the Fed is watching in order to gain that clarity that then will allow them to make their decisions.
Yeah, that's the question, right? When is enough enough? When do we have enough clarity? We'll try to get some answers. Our thanks to Crossmark's Victoria Fernandez. Now, coming up at the Open, as we were just talking about, an exclusive interview with Richmond Fed President Tom Barkin as officials seek clarity on Trump's trade policy. This is Open Interest.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asia markets. Welcome back to Open Interest. Here's the setup as we count down to the opening bell. You can see the S&P 500 up about 1.3% in the pre-market. Some back and forth when it comes to trade policy with the EU, maybe providing a little bit of a lift here. Of course, the S&P 500 actually fell last week by more than 2%, so a little bit of a bounce back right now, Matt Miller.
All right, yeah, we do have a bounce, although it was a big drop last week. In terms of some of the movers, individual movers this morning, Trump Media is on our radar announcing a $2.5 billion move to create a Bitcoin treasury, and you can see the shares up 4%.
We're also keeping an eye on PDD, Pinduoduo, reported the lowest adjusted operating margin in 3 years. Of course, those tariffs hitting that stock hard, down 17%.
And nuclear stocks like Centrus Energy extending gains after Trump's order to revive the industry. We saw them soar last week, and they continue to rise today. Less than 4 minutes until the opening bell. Up next, Tom Barkin.
much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
We are moments away from the start of trading on this Tuesday morning after a long weekend. We had a drop of more than 2% in equities last week. It was the worst week since April 2nd, and yields rose for a fourth straight week. Those two things look set to turn around this morning. You see S&P futures up 1.2%. We welcome our TV and radio audience worldwide. I'm Matt Miller alongside Katie Greifeld and Michael McKee, Bloomberg's international economics and policy correspondent. He is joining us now because we have an exclusive interview with the Richmond Fed President, Tom Barkin. Tom, great to have you on the program. Thank you so much for joining us. I have to start with the biggest question, which is in terms of the data. We've heard from Bostic and Kashkari that this data from Trump's trade war hasn't really told us all that we need to know quite yet, and maybe it won't until September. What are you seeing in your district?
Well, I'll agree with you that the published data shows an economy very much on the same trajectory that we've been on for the last year or two. Low unemployment, inflation settling toward target. There's a lot of questions about what happens when these tariffs are imposed, but you know how it is. There's a bunch of companies that advance ordered their product. They may have warned about price increases, but they haven't yet passed on the prices. The customers may accept the price increases, or they may not. So we'll just have to see how it plays out. I've been describing this when I'm talking to businesses, which you know I do every day. I've been describing this as driving through fog. It's just very hard to drive when it's really foggy. And businesses are afraid to accelerate because they don't know what's around the next curve. And they're also afraid to put on the gas because you don't want someone crashing into you. And so by and large, they're pulling over and putting on the hazards.
Well, to that point that you're constantly speaking to businesses, is anyone making big investments at this point or hiring decisions? From your conversations, do you get the sense that firms are close to announcing layoffs?
Well, so on the hiring side, you're definitely not seeing that. Lots of hiring freezes, of lots of deferred hiring, and you see that in the data as well. In terms of investment decisions, investment moves that were already underway seem to be continuing. I've heard very few cancellations. But some of the big things that you might expect to happen when the terms of trade change, I think people are still waiting to get whatever they think is final. In terms of layoffs, you clearly hear and see about it in the government sector and in those sectors related to government spending. But outside of that, I just think people have the hazards on.
How long are companies telling you they can hold out before they have to make some sort of decision as to whether to go ahead and invest or to cancel plans?
Well, I think people are pretty patient on the investment. A lot of these are growth investments, and they're waiting to see what the terms are. If you're thinking of building a new facility somewhere, you kind of want to know what the rules are before you build it. And so I think there's a lot going in there. I also don't think there's much case for canceling. Nothing's really changed in the economic environment. You just have policy uncertainty. And I think people are just going to wait policy uncertainty out. They do think there's a light at the end of the tunnel, that there will be some certainty, whether it's the tax bill or some of the trade terms. But I think they're just waiting it out.
Hey, Tom, I was on Saturday, I went down to Fredericksburg to purchase a used motorcycle, and I drove it all the way back here to New York through much of your district, I imagine, through Washington, D.C., of course. And I was thinking about DOGE, the Department of Government Efficiency. The cuts that DOGE made, have they had any specific impact on the companies, on the constituents in your district?
Well, first of all, congratulations on making it through the Fredericksburg to D.C. 95 district. That's a place that I travel a lot, and it's not very easy to travel it. There's no question that what we're seeing happen in terms of government spending cuts is affecting, especially the D.C. metro area part of my district. You see it in both announced job losses. If you look at Challenger job announcements in February and March, they were quite significant, particularly government side. We see it in the week-to-week government spending numbers, in retail spending, particularly discretionary retail spending in the D.C. metro area. Job postings are down about a third. We're even seeing listings come up in the residential real estate area. So you're definitely seeing that impact in D.C. metro.
I also want to get your opinion on what's going on with the relationship between hard and soft data. It's something that we talk about on the show quite frequently, because you have the soft data suggesting that things look a lot more stagflationary than the hard data actually shows. And I'm wondering whether the sentiment data, the survey data that we receive, is still a reliable indicator of what the hard data will eventually reflect.
Well, I separate business and consumer sentiment on that. I think business sentiment is a very good indicator of what you're seeing. And what you're seeing in the business sentiment is the surge in optimism that came anticipating pro-business policies after the election has backed off. And you see hesitancy to invest, hesitancy to hire. And that's the same thing you're seeing as you talk to businesses. And so I think that's very consistent. By the way, we saw the same thing in 2019, and I think it played out in a very similar way. Consumer sentiment, which historically has been strongly correlated with consumer spending, has not seemed to be for the last 2 or 3 years. I think that's pretty simple. Inflation is a big bugaboo in people's minds. As you know, everybody hates inflation, and the prospect of inflation drives sentiment down significantly. And in today's always-on media environment, where people look at notifications all day long, the notifications they're seeing are tariffs, inflation, and they're anticipating that. You can see that in terms of the consumer sentiment's expected inflation, 5 or 10 year, 1 year, 5 year, 10 year, whatever. And that takes sentiment down. There's no evidence yet that inflation-driven drop in sentiment drops spending. And nothing I'm seeing in the real-time spending data suggests that spending is dropping. But that's why I say there's the disconnect on the consumer side. Sentiment seems very clearly moving things on the business side, less clear on the consumer side.
Tariffs, as you mentioned, is what we've been talking about for some months, but now we have the budget bill on the horizon, the fiscal side of it. What are people telling you in your district, and you have a lot of rural areas as well, about the potential effects on the economy from the bill? Some see stimulus from no tax on tips, no tax on overtime. Maybe that's an inflation problem going forward. And others say maybe there's a problem with consumer spending going forward because people are losing income from Medicaid and other cuts. How do you see that affecting the economy?
Well, I was in rural Virginia, as I was telling you earlier last week, and we had a lot of conversations about how they're seeing policy. I don't think this has reached the level of much focus in the small towns, at least in my district. I think people are focused on the basics. The places people they worry about healthcare. Rural healthcare is a pretty big issue in the small towns, and people wonder about how any changes to healthcare is going to affect rural hospitals. And I think people are just waiting to see where Washington lands on this.
We had a drop in GDP that surprised me last quarter. I talked to the experts here at Bloomberg about it, and they told me that's okay. It's because we were pulling forward so much ahead of President Trump's tariffs. And now that he's pushing those tariff dates back, I wonder if you think companies and consumers are going to continue to pull forward and bring so many imports in that we get another big drop in GDP. Tom, could we have a technical recession because of this?
Well, so the businesses who are facing these tariffs go in one of two directions. There's some set of people who pull forward, and you certainly saw that in pharmaceuticals in the first quarter, stockpile inventories in advance of tariffs. But there's another set that are actually pulling back and saying, and we saw that in China, if you look at the shipments out of China, out of the ports, and they're saying, look, I'm not taking this till I see where it goes. Now we've got a different tariff regime in China for some period of time. We're not yet seeing much movement in terms of shipments out of China. It, I think, takes a few weeks to get that going. And I just think we're going to see some back and forth on this this quarter, next quarter, and we're just going to have to get the other side of it. Again, it's part of why I say there's so much fog here, because you might say we had a great consumer spending month in March because auto sales boomed, or you might say that people bought their cars before they saw price increases.
Well, as we wrap this up, when you look forward, which part of the mandate do you think we'll see an effect first, on the inflation side or the employment side?
I'm more balanced than a lot of what you read. I could describe to you how some of these forces like tariffs might be inflationary. I can describe to you how other forces like lower gas prices might be disinflationary. I could describe to you how less government spending might be less employment, and that has issues on the employment side. I can also describe to you how people who haven't hired for 18 months, if spending continues, might need to start hiring. And so I'm waiting to see what happens.
All right, a great conversation to start this week. Our big thanks to Richmond Fed President Tom Barkin and Bloomberg's Michael McKee. Meanwhile, let's get back to these equity markets and take a look at the breadth right now, because boy, there is a lot of movement to the upside on the S&P 500. If you take a look at the breakdown of this rally right now, you can see we have nearly 450 names in the green on the S&P 500 to start this week, just 53 moving to the downside right now. That's pushing the index up after a brutal week last week. And here are the companies doing all the work. You have NVIDIA higher by about 2%. That is your biggest points contributor to the index, as you might imagine. But you also have Microsoft, Apple, Tesla, Broadcom really helping this rally to gain momentum right now. On the downside, you do have some earnings names. I want to highlight AutoZone, for example, delivering a disappointing report this morning. You can see that's falling. Salesforce falling with, of course, that M&A deal announced. We'll get to that in just a bit, and Progressive as well. But let's take a look at the sectors right now, because I was talking about good breadth, and you can see it very clearly when you take a look at all 11 sectors in the S&P 500 higher right now. As you might expect, you have big tech up at the top, up 1.6%, green all the way down. But again, NVIDIA putting in the work ahead of earnings tomorrow. Matt Miller.
Can't believe AutoZone was disappointing. I was just in there buying a new pair of C-clip pliers last weekend.
There you go.
All right, well, I guess I didn't move the dial. Coming up, we're going to take a look at NVIDIA's earnings. They're tomorrow. Don't worry, you haven't missed anything yet. It's the world's most valuable chip maker, and it reports after the bell on Wednesday. That's next on Bloomberg Open Interest.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China is going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, spam maker Hormel getting upgraded over at BNP Paribas Exane. The firm says that a favorable turkey market is a tailwind for the canned meat manufacturer. And I read that sentence a couple of times because that sounds quite icky. Next up, we have Southwest getting upgraded over at Jefferies thanks to cuts to underperforming cities and the carrier's progress in maximizing revenue per square foot. And finally, we have CoreWeave getting its first downgrade since its IPO. Barclays is cutting the stock, with the analyst saying that he's optimistic long-term, but the short-term upside is limited. You can see shares still up about 11.5% though, Matt.
They have absolutely crushed it since
that
the
Haverford
IPO.
Influence, as you know well.
Yes, you know, anything related to Haverford seems to be doing very well this year. All right, tomorrow is arguably the biggest day of this earnings season. NVIDIA will report earnings after the bell. It'll be a key bellwether, maybe the key bellwether as investors gauge AI demand. Is there anything else? I guess not. Joining us now is Bloomberg Technology co-host Ed Ludlow. Ed, it's all about NVIDIA. I can't really overstate that, can I?
No, you can't. It's almost like a macro level event, right? For literal reasons, because of its weighting on indexes, but just because of how much of a monopoly it has in the market for the technology that powers AI. But what's interesting this time around is top line growth of 65% is still astonishing unless you go back 1 year when they were growing at 250% a quarter in the data center business. And there are lots of questions we have, particularly about China. They had this chip called the H20, which was specifically designed for the Chinese market. It was lower power in order to conform with US technology export rules. And in the quarter, including the period in April, they did a $5.5 billion write-down. We know about the write-down, but you have to then do the math on revenue lost, basically, in the period gone and the current period, and what kind of big picture future NVIDIA sees for China, because it was the most important market in the world for data centers, and now maybe not so much.
And I'm reading the room here, and I get the sense that Matt is tired about talking about NVIDIA. So I'm going to move on. I'm going to talk about Tesla, because Tesla, we did get some news out of the EV maker this morning, and it was bad news, actually, that their European sales slumped by 49%. You wouldn't know it by looking at the shares this morning, up about 4% right now. It feels like, in some ways, it's become disconnected, this stock, from the fundamentals.
Share move really weird, not only because it's almost 50% sales slowing decline in Europe, in a market that's growing is unusual. But also, if you look at what's happening in China, BYD very heavily cutting prices across many models, something that many domestic makers are doing in China, you have to ask the question if Tesla follows suit, right? Because they follow the same logics and strategies in that market that the domestic names do. So I haven't a good answer as to why the stock's buoyant, other than perhaps the commentary from Elon Musk in the latest earnings call and part of our discussion with him last week at the Qatar Economic Forum. Maybe these European pieces of bad news were baked in, maybe.
He called out humanoid robots, which we continue to just skip over and pass by. I can understand why no one cares, but does no one care, Ed?
No, people care, particularly if you're in the group of sort of category of retail shareholder, Tesla owner, Elon Musk supporter and fan. And this is the dynamic, right? If you go on ANR on the Bloomberg terminal and you look at, with respect, the sell-side analysts that cover Tesla, many of them are sort of legacy automotive industry analysts. But there's the school of thought that you don't even model this company as a car company anymore. Just forget the car business. Because Elon Musk keeps telling us it's a future where they're an AI company with the biggest addressable market and volume of sales being humanoid robots powered by that work in software. That's one way to look at it. And so if you're modeling it, as Katie says, on the fundamentals of a business selling EVs to consumers, that's hard math to math.
All right, Ed, thanks very much, and we look forward to your program, Bloomberg Technology, at 11 a.m., so an hour and 10 more minutes. I'm not tired of NVIDIA.
It's okay if you are.
It's just that, I mean, I know that we want a drumbeat to these things, and we're going to preview them, but the earnings don't come out until after the bell tomorrow.
I know, so get ready for more drum beating tomorrow at this time. But I do think that Ed made a really interesting point when it comes to the humanoid robots, your point that no one cares. Retail investors care, but I think when it comes to, I don't know, the big money managers, I mean, how do you value that? How do you price that in?
But retail investors are the reason that this is a $1 trillion, $1.1 trillion stock.
Yes.
So we can go on about declining auto sales. Obviously, no one cares, right? I mean, it doesn't, this is not a car company valuation. All right. I beat that drum hard enough.
There you go.
Coming up, Salesforce agreeing to buy a software company, Informatica, in its biggest deal since Slack. We'll have the details next. This is Open Interest.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. A big rebound from a bad week. Right now, the S&P 500 up 1.2%. I believe for the week it was down 2.7%. So we're gaining back less than half of what we lost, but that was obviously over 5 trading days. The NASDAQ is gaining more as NVIDIA is the great hope to continue driving this market. We do see in terms of that stock, it's up 2% right now, and Apple also a gainer today. So those are 2 of the 3 biggest stocks in the world rising and helping to buoy the index. P. Diddy Holdings is down almost 20% right now after, I guess there's a Temu issue there. AutoZone, same-store sales missed by like a full percentage point, down 9% and change. Salesforce making a big deal that we're going to talk about in a second, and it involves Informatica, which CRM is buying, Katie, for $8 billion.
Yeah, and it's interesting to see Salesforce shares a little bit higher on the heels of that news. One of its biggest acquisitions, an $8 billion deal. Let's break it down now with Liana Baker. She leads M&A coverage for Bloomberg News. She broke news of this deal last week that we could expect to see it this week. So let's discuss now. This one is an interesting one because these 2 companies were in talks not too far ago, and now it seems like they're finally going to put this over the finish line.
What we say in M&A circles is that no deal ever dies. We saw this with Google Wiz a little while ago, and when companies get close to the finish line on deals and they don't happen for whatever reason, we always expect them perhaps to come back. What's interesting here for Salesforce is that it's its first big acquisition since it was in the crosshairs of activist investors a few years back who were actually criticizing Salesforce for their acquisition strategy. So they had sort of taken a breather, done some smaller tuck-ins, but now they're back in a big way. But they're saving about $2 billion from when they last spoke.
So what does this company do? Salesforce, I guess, is also trying to cash in on this AI, I don't want to say craze, because it's going to be the way we live from now on, right? Is this going to help them?
From what I've read, Informatica is going to help its AI agent business. Informatica is a long-time company that I've known. They're originally in the middleware space. They actually went private almost 10 years ago by private equity. We covered the IPO in 2021. So they've sort of been around the block, but they help with data management for companies, and this is going to help Salesforce sort of roll out more of these AI features, and it's Mark Benioff's way of, coming back to the M&A market, which we'll love to see.
Talk to us about potential regulatory concerns here. That still, even under this new administration, is very much a thing, and you think about the potential overlaps here. It's not insignificant.
Salesforce owns a business called MuleSoft, which they bought also a couple years ago, which competes with this company, Informatica. So we'll see how regulators look at this one. It's always high profile with Salesforce, but it's hard to say if it's a litmus test for regulators, but obviously any deal with a big price, with a well-known buyer, we'll be watching to see, how regulators decide whether it could go through.
All right, Leanna, thanks so much for joining us. Leanna Baker runs our deals team here on the BN side. Coming up in the next hour, RBC's Amy Wu Silverman joins us on Wall Street's hesitation to buy the dip. We will also pepper her with questions about NVIDIA. Plus, Jay Hatfield argues we will not see a U.S. recession due to his rule on housing starts, and we're going to ask him about rates as well. Remember, he had a bullish forecast, but it was predicated on 3.5% 10-year yields.
Right, yeah, which it certainly feels like we're far away from that right now. The 10-year yield hanging out around 4.5%. It feels like it was close to there when I left.
Yeah, well, it rose a little, but maybe there's more demand for long-term debt. Today, this is Open Interest.
House, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area that comes out in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Another financial hit for Harvard. A senior Trump administration official tells CBS News a letter is going out to federal agencies directing them to cancel all remaining contracts with the university. They're estimated to total about $100 million.
On NPR, Harvard President Alan Garber called the administration's measures
perplexing.
And he says cutting research funding
does not help the country, even as it punishes Harvard. And it is hard to see the link between that and, say, anti-Semitism.
He said Harvard, along with other institutions,
we all need to redouble our commitment to the good of the nation and the world. And I know my fellow leaders fully embrace that.
Stacey Lynn, CBS News, Washington.
It comes a day after the president said he was considering taking billions of dollars in additional grant money from Harvard and redistributing it to trade schools. We just learned National Public Radio and 3 local stations have filed a lawsuit against President Trump, claiming his executive order to end federal funding violates the First Amendment. On Wall Street, stocks are rallying after Mr. Trump said he would delay 50% tariffs on the EU to allow more negotiating time. The Dow is up 398 points right now. Search is on for an ex-law enforcement official after he apparently walked out of a prison in the South Sunday. CBS's Katie Weiss.
Police in Arkansas are searching for 56-year-old Grant Hardin, a former police chief who escaped from prison where he was serving a decades-long sentence for rape and murder. Hardin escaped from the prison Sunday through a sally port, wearing an outfit designed to look like he was a member of law enforcement.
We're looking into now how that was made, how that was acquired, and how he was able to get outside the gates with that on.
Police in Liverpool, England are trying to find out why a driver plowed a minivan into a crowd of people celebrating the winner of the country's premier soccer league championship. This man was there.
Suddenly the car reversed and there was a loud bang as it connected with the ambulance behind it, and then all of a sudden the car accelerated and shot off through the crowd, and at that point the atmosphere changed so quite drastically, and what had been a day of joy and celebration just turned into horror and panic. panic.
Officials have ruled out terrorism. A former employee of Sean Combs could take the stand at his sex trafficking and racketeering trial. CBS's Katrina Kaufman from New York.
Today, we are expecting to hear from Capricorn Clark, one of Sean Combs' former assistants, but she also worked her way up to being an executive at his company.
She once called Combs the devil. NASDAQ's up 286. This is CBS News. A new way to get your daily dose of vitamin A.
Meet Tim Cranmore, founder of the London Vegetable Orchestra, playing a recorder made from a carrot. He makes real recorders for a living and says carrots have a lot of the same properties as the wood he normally uses.
So there's no reason why a carrot should not make a recorder every bit as good as a tree.
Even better, if you think about it. I mean, if these musicians feel peckish after playing their instrument, they can always eat it. Vicki Barker, CBS News, London.
The Supreme Court has just rejected an appeal from members of the Apache tribe who want to stop a massive copper mining project on federal land in Arizona that they hold sacred. The justices have left in place lower court rulings that allow transfer of the land in the Tonto National Forest, known as Oak Flat, to a company called Resolution Copper. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
Are people just too exuberant out there?
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube as well. Alex Steele and Paul Sweeney with you. Coming up, we're going to check in with Stephanie Guichet, senior economist at the Conference Board. We had some consumer confidence data that came in better than expected. Remember, last month it really took a deep dive, getting a little bit of recovery there. So we'll talk about that. Ira Jersey, Bloomberg Intelligence Chief Interest Rate Strategist, is going to join us to tell us what the Fed's going to do, if anything, come the June 10th meeting. Ross Matheson, Bloomberg News Director for Europe, the Middle East, and Africa on the EU and tariffs. Looks like both sides are now going to get together and talk. We've seen this playbook before, announce a big tariff. Folks then come to the table, maybe get something lower. So we'll get the latest reporting there. But right now, let's go to John Tucker and get a Bloomberg Business Flash. Go.
And this flash brought to you by IBKR. Will the year-over-year change in the U.S. CPI exceed 2.7% in May 2025? At IBKR Forecast Trader, the yes was recently at 23%. Start predicting today at ibkr.com/forecast. The last trading day for this contract, June 19th. We're data dependent, so let's start there. The Conference Board's Consumer Confidence Index coming in at 98, blowing away the estimates. Economists surveyed by Bloomberg were looking for 87.1. We'll break that down in just a second. Let's make a deal. Salesforce agreeing to acquire Informatica for about $8 billion. You remember they tried to do this like a year ago, and that fell through. Investors waiting for the big earnings report of the week. NVIDIA after the close tomorrow. Meantime, Steve Chiabarone at Federated Global looking for a rally in stocks to continue.
I think there's still buyers to come into this market, and I think the most likely outcome here is a slow
soul-crushing grind higher in U.S. equities.
Right now, the S&P 500 up 77 points, a rise of 1.3%, 5880 on the index. The Dow up 385, the NASDAQ 100, 363 points higher. Starting tomorrow, Southwest ending its 2 bags fly free policy. They even said how much they're going to charge check bags. This, of course, had been a mainstay at Southwest. Yeah. Believe it or not, baggage fees bring in about over $7 billion for airlines. That was last year.
Baggage fees are insane.
That's ridiculous.
It was like $70 when I went to Costa Rica. We had to check 3 bags. It was $70 a bag.
Wow. No.
It was bananas.
Johnny ain't going to pay that. We check the markets for you all day long right here on Bloomberg
I
Radio.
go to Europe for 2 weeks. I can put it in just like a duffel bag. Let's go. 1 gray suit, 5 shirts. You're good. I mean,
okay.
Well, you can just wear everything on you and just don't check anything.
In all fairness, this was my best friend's fault, who lives in Costa Rica and basically made me bring her a suitcase full of stuff.
Oh, okay.
And then once you check one thing, we're just going to check everything. So anyway. All right, JT, thanks a lot. Alex Steele here, alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. All right, let's get to that consumer confidence number, jumping the most in 4 years on outlook for a better economy as well as trade truce. Joining us now to break down those numbers even more is Stephanie Gouchard, a senior economist at the Conference Board. Is this truly all relief on trade at this point?
It's largely, we split our sample around May 12 to see whether there was a stronger improvement in the second half of the month, and there was. So it's really after the trade deal with China that we saw strongest improvement in our indicators, especially the expectation component.
So in your index here, what's the makeup of kind of consumer confidence? Is it how much is kind of jobs? Do I have a job? Or is it more about inflation? What am I going to have to pay for stuff? Just general economic uncertainty. How is that weighted?
So it's a lot about jobs, both in the current situation and in the expectations components. And one thing to note is that the current job situation is the only component of the index that didn't improve this month. So there are still some concern about, where the labor market is going right now. And we don't explicitly have an inflation component in the index. However, we ask consumers about how they feel about their future income, which could be something like capturing, whether they are going to get enough money to pay for what they need. And that's one of the components of the expectation component. But it's not really about inflation overall. It's more about the labor market.
Okay, Stephanie, thank you very much. Really interesting. And also, we have not recouped, though, the big decline that we've seen. It's not a full V yet, that recovery for consumer confidence. All right, Stephanie Gouchard joining us there from the Conference Board. Paul, let's take a look at some of the movers today. I'm Alex Steele with Paul Sweeney. We're joined by Bloomberg's Christine Aquino. Let's kick it off with Salesforce. There is a merger Tuesday/Monday.
Absolutely, Alex. Salesforce, John Tucker mentioned it earlier, right? That is quite a big deal. It's about an $8 billion acquisition of Informatica. And this follows a failed attempt barely a year ago. So both companies revisiting that deal table there. And, it does add to more than $800 billion of North American deals so far in 2025. That is more than a 23% increase from a year ago. So looking at this deal specifically, our Bloomberg Intelligence analysts do say that Informatica's slower growth of around 4% is negative versus Salesforce's stronger 8 to 9% growth. But the deal value does adequately reflect this risk, and it does show that Salesforce is willing to allocate more resources to data management, given its recent success in the data cloud sector.
And the valuation is lower this time around. It was $10 billion when they first tried to do this deal a year or so ago. Now it's $8 billion, so a little bit of a markdown there. JP Morgan representing the buyer, and Goldman Sachs representing the seller.
He always likes that. He always likes that. He likes to see who's making all the money. So let's go more into Southwest Airlines. The news there, of course, is that second bag, right? You're going to have to start paying to check your bag.
That's right. And, based on the share move today, investors love that. It's up currently more than 3.5% from the open. It's quite interesting, though, because, again, this is definitely not happy news for consumers, especially because the summer travel season just about to get underway. We paying for bags collectively. And interestingly, just last week, the Southwest Airlines CFO was warning of ongoing softness in travel demand. So maybe this is a move to compensate for that slowness. Key question is whether consumers would be willing to absorb that cost. But based on that consumer confidence number, maybe they will be.
Yeah, I fly out of Newark, so I'm captive to United. I've only flown Southwest maybe like 2 or 3 times in my entire life. It's different experience. And I know people who fly it love it.
Yeah, it's not my thing.
Yeah,
it's not my thing.
People are at very high loyalty.
I know, but
so
then
we'll see what happens now.
But if you take this away,
Yeah,
exactly. How's that going to go? All right, Broadcom, let's wrap this one up.
Broadcom up 2.6% at the moment. We do have that company reporting results next week. And so we have a lot of kind of just pre-earnings optimism there. We have Bloomberg Intelligence's Robert Schiffman noting that its revenue diversity and cash flow does boost its relative value appeal versus its peers in the sector. It's probably, you know, relatively cheap compared with NVIDIA and the likes. Bloomberg Intelligence also touting strong relative total debt and equity returns. And so, yeah, we await what comes of that Broadcom report. And with that, actually, we wrap up most of the big tech names reporting. NVIDIA, of course, reporting ahead of that later this week. So,
yeah, finally, NVIDIA. So that's will be a big name for the market. Christina Aquino, thank you so much. We appreciate that. Christina Aquino, managing editor for Markets Live at Bloomberg News, joining us here in our Bloomberg Interactive Broker Studio. For more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Well, one of the news stories coming in early this morning, not as early as John talked, but coming in early this morning was kind of Japan trying to stabilize their bond market there. And that's had some nice repercussions kind of throughout fixed income markets around the world. Again, the 10-year Treasury is up 30 seconds, pushing the yield down to 4.46%. I'm going to check out Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. He's on his cam down in Princeton, New Jersey. Ira, what do you make of the news out of Japan, and how do you think bond investors generally are feeling about sovereigns right here?
Yeah, so there's still a little bit of queasiness about sovereigns in general, especially with the expectation of continued supply out of the U.S. and Japan, and then new supply out of Europe, you know, in particular in order to pay for some defense spending. But you know, the news that we received over the weekend certainly has stabilized things a little bit, and we have to remember global bond markets, especially in the more liquid, large sovereign markets like Japan, the U.S., Germany, UK, tend to be correlated at different periods of time. So if there's angst going on, for example, in the JGB market, like we saw last week with the Bank of Japan pulling back some of its long-end purchases, then that has had effects on other markets as well. And I think that, you know, the stabilization you're seeing, you know, will it last for a long time? That's hard to tell right now. But I do suspect that it's at least a positive for the short term.
Just some breaking news for you. Nippon Steel is expected to buy U.S. Steel at around $55 a share. That's according to CNBC. Currently, U.S. Steel is trading around 52. Now, this follows the news on Friday that President Trump backed a U.S. Steel partnership, and shares rose ahead of that. And then again, now we get CNBC saying that the takeout price should be $55 a share from Nippon Steel to U.S. Steel. So, Ira, are we learning that there's a cap now for long-end bond yields, period?
Yeah, I think we're once again testing the cycle highs in the long end. So the 30-year, you're talking about 5.17%. That was the high back in 2023, where we tested that again. Now we're below 5%. When you get to these kind of levels, there's a captive buyer base that tends to come in, and even though there's we focus a lot on the 10-year, the 30-year has kind of its own demand that isn't necessarily driven by the same economic factors as the belly of the curve, so the 5-year and the 10-year, because the long end is used in a lot of pensions and insurance companies and life insurance companies in particular use that part of the curve in order to get the assets that they need to cover their liabilities. A lot of that ends up being in, say, 30-year corporate debt, but they also use treasuries, particularly when you're at or above 5%. And so there is a lot of demand there, and I think we've proven that once again. That once you see that 5.1%ish, you're going to have people coming in on Monday morning and saying, okay, let's take some risk there and cover some of our duration gap that we have to buy.
Ira, thanks so much. Appreciate it. As always, Ira Jersey, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence, joining us from Princeton here. So again, looking at the bond market, again, a little bit of a pullback in yield here on the 10-year, 4 basis points, 4.69%. And I got to call out for Tom Keene, Bitcoin, $110,000. Unbelievable. So,
yeah.
I mean, if you were buying that back then at 60,000, good for you.
You know who wasn't buying that? Me.
Yeah, exactly. I mean, I missed gold, missed it all. Ross Matheson, she's going to join us in just a moment. She's Bloomberg News, talks about what's happening with Trump's tariffs from a European perspective. That's coming up.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg News with this Bloomberg Business Flash, brought to you by Oracle. Attention growing businesses, Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitments. See if your company qualifies at oracle.com/Bloomberg. Let me start off with this breaking story that you actually touched on, Alex. According to CNBC, the Nippon Steel expected to buy U.S. Steel $55 a share. Right now, shares of U.S. Steel, after the surge on Friday, they were up another 1.7%. Now, remember, in a post on social media Friday, the president heralded what he called a planned partnership between the two heavyweights. So the president told reporters at the airport in New Jersey as he headed back to Washington that, quote, it's an investment and it's a partial ownership, but it'll be controlled by the USA. So there you go. Anyway, U.S. Steel shares closed more than 20% higher on Friday. So if they're paying $55 a share, there are 226 million shares out. That works out to $12.5 billion. I'm
going with your math.
By my math.
He literally was doing back-of-the-envelope calculations and saying
initially, you'll recall, they made a $14.1 billion takeover offer. So that's the latest anyway. Risk on move this morning comes, of course, after President Trump extended a deadline on tariffs on the EU until July 9th. Right now, the S&P 500, 88 points higher. That's up 1.5%, 58.91 on the index. The Dow up 490 points. The NASDAQ 100, 400 points higher. Factory orders for business investment, that's a key gauge of corporate investment. That dropped for the second time in 3 months. And Bloomberg Economics says businesses at this point have no desire to commit to long-term expansion. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash, Alex and Paul.
All right. Thanks so much, John Tucker. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We're broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. Also check us out on YouTube, Bloomberg.com, as well as originals on Roku and your smart TV, anywhere where you get your news. So the news over the weekend, as well as this morning, is President Donald Trump rolling back its tariff deadline and tariff amount on the European Union, saying that it's speeding up its trading negotiations, and he thinks this is a positive event. Now that deadline's extended to July 9th after a call this weekend with European Commission President Ursula von der Leyen. Let's get more on this with Roz Matheson, Bloomberg News Director for Europe, the Middle East, and Africa. Roz, what do we know that the EU or Ursula von der Leyen offered President Trump to make him feel so good about it?
Well, part of it might have just been that phone call seemed to have gone smoothly, but also what we saw from the markets when he threatened the 50% tariff may have also perhaps entered into Donald Trump's thinking. But as you say, we do know after that call that he walked back that threat. So we've got a bit more breathing space on the EU side to get talks going. And now the question is, how can talks occur in a proper way? And what is the EU going to do potentially to crack open the door with the US without giving away its own red lines? Because the EU does have a whole lot of stuff that it's just not willing to give ground on. We do know they seem to be wanting to now split up the talks a little bit, so separate all these big things out into smaller pieces and see if they can make any traction on individual things. So more on the political side, there's hot button issues around autos, pharma, civil aircraft, chips, and so on. And then a more technical level conversation around things like non-tariff barriers. So split everything up into smaller compartments again and see if they can edge anything forward. But in doing so, you do also risk fragmentation. And the question is, in conversations going forward, do you end up with partial bits of a framework deal and nothing really complete? And what then happens if we get very, very close to this July deadline and things are still deadlocked?
So, Ross, how united is the European Union in these negotiations here, in these discussions, do you think?
Well, that's always the classic question, isn't it, with the EU, unity in the minute, because it is a bunch of very different economies and very different politicians leading each country. In this case, there does seem to be a decent amount of unity. You're not seeing some of the bigger economies speak out necessarily against each other. I mean, that's been the weakness and the strength of the EU for many, many decades, is trying to peel individual leaders away from each other. We've seen that, for example, on how to handle the war in Ukraine. But on this, they do seem to be unified. So even some of the economies that have tended to side with Donald Trump are falling in line. The question again is, like, is there any wiggle room between the EU and the US to get to some kind of framework agreement? Or are we going to see this all happen in July supply, and then EU retaliation, which could be quite significant, kicks in automatically at that point. And so it's really down to the negotiators at this point to see if they can find common ground, and the role potentially of Ursula von der Leyen in that, her chief trade negotiator, who's been talking a lot with US officials like Howard Lutnick, for example, and Jamieson Greer of late. Is that personal relationship going to get any kind of traction? And are they able to represent the EU collectively then as a whole?
But that's sort of what confuses me, because is it concrete stuff, or is it just having a good phone call with President Trump? And like, what can Europe actually offer that's concrete, that's not going to make all the other 26 members mad?
Well, that's the thing. It does seem to be quite personal, right? When I was thinking about recently to Donald Trump's first term in office and some of the trade tensions with China, for example, that came up at the G20s and so on, and how it always took like a meal with Xi Jinping, sitting down at a table together, that leader level conversation to break the ice, to get a thaw, even if it's temporary in trade tensions. We saw that with China over and over again. And then, of course, it all fell apart some months later, and we were back to a trade war. So it does seem to be quite personality dependent. And it's about, again, the EU does have its red lines. It's not going to roll over in order to get a deal. Equally, it's about letting Donald Trump feel like he's got a win on some parts of it, potentially. So it's a very careful exercise. In this case, the EU is saying, you know, these negotiators are representing all of us. You can't try and come to each leader individually and peel us off. The representatives for us are the people who are talking to you. So this is the EU chief negotiator, for example, Šefčovič. It's also Ursula von der Leyen and those in the Commission. So they are holding the line on that versus coming individually. But again, do they have that personal rapport that's going to get this over the line?
Ross, thanks so much for joining us. Really appreciate getting your reporting. Ross Matheson, News Director for Europe, the Middle East and Africa for Bloomberg News, joining us via Zoom from our London headquarters at Queen Victoria Street. Okay, buy the dip, we get that. How about buy the rip here? I mean, the S&P's up another 1.5%, so it's almost like, you know, don't worry about it. The S&P's pretty much flat year to date. Let's talk to the professional who does this stuff for a living. Olalu Aganga, she is the U.S. Chief Investment Officer for Mercer, joining us live here in our Bloomberg Interactive Broker Studio. Thank you so much for coming in. Was it just kind of all about nothing here? We had a 20% decline in the stock market. People were really concerned, recession talk. Now we've retraced a lot of that. Where do we go from here? How do we go from here?
So there's been a decent amount of intraday volatility, intra-week volatility. Yep. We have been telling clients for a very, very long time to stay balanced and stay neutral. Now, there has been a tendency, even if you were to look at the market performance last year, to go overweight certain regions. You know, the U.S. for sure had been outperforming for quite some time. If you'd done that, you'd have had a really, really tough first couple of months, right? Your stomach, the pit would have been there. And now we're pretty much flat. Overall, we are still fairly neutral equities, a little negative due to the tariff concerns, right? Because that is a tax ultimately on corporate earnings and forward earnings, which is what you're buying. Mm-hmm. The one thing that I would say, though, that we are recommending clients do is to hedge their currency. So if you are a non-dollar investor, currency is an unrewarded risk. That has been extreme volatility. The dollar is down 8-9% year to date. That one you should hedge.
When we talk about how to think about what comes out of from the White House, it feels to me that one of the most important things we learned over the weekend was that President Trump said that he agrees with Scott Bessent, the Treasury Secretary, that we shouldn't be making shoes and shirts in the U.S., which makes me think that we're going to see more carve-outs, that we're going to see industry-specific carve-outs for imports, which will then kind of help smooth everything over. What do you think about that? Does that change how you look at sectors? Does it change how you look at the equity market?
It's hard to tell because it's not stable just yet. So there's a view that comes out this week. It could change next week. Or earlier today, I think we were seeing some talk about, you know, iPhone or whatever production happening domestically. It varies. I think the one thing to pay attention to, though, is if there is going to be more production in the U.S., which it seems like that is a bigger trend, how is that going to happen given labor costs? We've talked about AI, we've seen AI booming, but there are different aspects of AI. One, you know, pretty obvious one is robotics, right? So could there be a rise in robots that are manufacturing, and that's how we get the cost efficiencies there. But within AI, there's still pockets that could benefit here, given the shift to more domestic overall. How much, we'll see, but it's more than what we have today.
You mentioned the dollar. I mean, risk assets, if you define that as stocks, they're back. No problem there. But the dollar's still down, as you mentioned. And just it's not bouncing at all. What's that telling you?
In our large asset owner survey, trillions of dollars in management, global clients, 16 countries, ultimately, what we started noticing was a bit of a home bias for non-U.S. institutions. They were looking more at their country investments. They hold dollar this is part of their overall asset holdings. They've started to diversify. We've been seeing that move overall. So the volatility we're seeing more and that is sticking is in the currency aspect of things now that there are different options that are there, and people, you can't necessarily shift away from the dollar fully, but more around the edges.
Yes, and we saw earlier, right, with the yen hitting a low, right? It was like around that 140 level to the dollar. Okay, so currency volatility here to stay, so you got to mitigate that. Rate volatility?
Rate volatility has been tough. Fixed income, which has been the ballast for a long time, actually it hasn't. It's been pretty tough looking at treasuries and bonds. So we're seeing more and more volatility building in fixed income, which is why for us, as we start building diversified portfolios, you have equities, you have fixed income, but we have really been advocating more diversifying strategies and hedge funds. So low correlated asset classes or more low correlated strategies, because fixed income has been somewhat correlated to equities. There's a lot of volatility in equities, a lot of volatility in treasuries as well.
I just want to point out 144 yen dollar today.
Yes.
Just pointing that out.
Exactly. Real quick, I mean, we had that move out of U.S. equities into European equities earlier in the year. Was that just a trade, or is that something you think longer term?
From a tactical basis, it's been more of a reallocation. There was, we weren't necessarily recommending this, but we were seeing a good amount of flow coming into the U.S. So in a balanced portfolio, call it the equity, 60-something% U.S., accounts were holding a lot more than that. So this was more reallocation back to balanced holding, where you'd seen a bit of a skew more towards U.S., and we'd recommended more balanced.
Love talking to you.
Yep.
Really wonderful stuff. Thank you so much.
Thank you.
Olalu Aganga is U.S. Chief Investment Officer at Mercer, kind of breaking down how to think about the market, how to manage the volatility, particularly in the FX market. All right, you ready for some nuclear, Paul?
Yes.
Yes, we are doing it. So on Friday, President Trump signed a host of executive orders targeting nuclear energy to make it easier to build plants and get them up and running here in the United States. And we're going to talk to the CEO of one company, Terrestrial Energy. It's currently going public through a SPAC, a special purpose acquisition vehicle. They're also in charge of building small modular reactors. So they're basically smaller but more uniform. So they should, in theory, be easier to build. We just have to get that cost down. So we're going to break down what all of this means for his company as well as those new rules. As you take a look at an equity market really flying higher here, the NASDAQ up full 2 percentage points. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. A risk on again after President Trump postponed the EU tariffs. All 11 major industry groups in the S&P 500 are up. Best performing stocks in the index include Super Microcomputer, United Airlines, and Tesla. And right now, the worst performing stock in the index is Fair Isaac Corporation of Bozeman, Montana. That's FICO, down over 9%. The FHFA director says he's still not happy with FICO and that his agency is going to make some decisions on the rising cost of credit score reports. And then at the top of the hour, you heard consumer confidence rebounded sharply in May from a near 5-year low. This was the Conference Board's gauge of confidence, increasing over 12 points, marking the biggest monthly gain in 4 years. Meantime, Amy Will-Silverman at RBC Capital Markets says investors would prefer to deal with the tariff fallout later down the road.
I don't think investors think everything is fixed. They just think that it's going to have to be addressed further down the road. And so I don't think you're going to get this erosion of volatility, perhaps in the short term.
Right now, the S&P 500, 90 points higher, a rise of 1.6%, 58.92 on the index. The Dow up 500 points. The NASDAQ 100, 402 points higher. That is up 1.9%. Yields real quick. The 30-year bond is down 6 basis points, under 5, 497 right now. AMC Entertainment had a record-breaking Memorial Day holiday weekend. More than 7 million people visited an AMC in the U.S. or an Odeon cinema location internationally. It was driven by the robust openings of Lilo and Stitch and Mission Impossible. Let's hope it's the final reckoning.
Did you guys see it? I saw it.
And you saw Lilo and Stitch or Mission Impossible?
Mission Impossible.
Okay.
It was real long. It was really long. Like, did it really need to be 2 hours and 50 minutes?
If you didn't like it, I will absolutely hate it.
I loved it. Like, you just blow stuff up. Like, people are having fun. Like, it's great. I mean, you know, I love those kind of movies. But
you
it was
didn't go to Lilo and
very
Stitch
long.
with your
I did not. I made her sit through Mission Impossible, which she did not necessarily love.
I'll wait for the book to come out. We check the markets for you all
But
day
Lilo and
long.
Stitch beat Mission Impossible handily. Yes,
Wow.
handily. Which is also like, you gotta feel a little
How
bad
old
for
is
Tom Cruise.
Tom Cruise
60
still doing
plus.
this?
He's still doing it.
Okay.
The first Mission Impossible, Dead Reckoning, comes out. It gets whipsawed by Barbenheimer. So Barbie and then Oppenheimer. And then now it gets whipsawed by Lilo and Stitch.
All right. 2 more movies I'll never see. We check the markets for you all day long, right here on Bloomberg. I'm John Tucker. That's your flash, Alex and Paul.
All right, thanks so much, JT. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. So Friday afternoon, President Trump signs a slew of executive orders targeting nuclear energy. So trying to free up the NRC, which is the Nuclear Regulatory Commission, to help speed up new reactors and help to expand current reactors, capping hourly fees, all to grow nuclear capacity here in the U.S. Joining us now to discuss is Simon Irish. He's CEO of Terrestrial Energy. Terrestrial Energy is a company that is hoping to build small modular reactors. They're called SMR. That the hope is to make nuclear power more efficient and cost effective. The company is also going public through a SPAC, special purpose acquisition vehicle, with an equity value of about $925 million. Simon, really good to get your perspective. What was the most significant thing that President Trump did on Friday?
Well, I think he recognised that if the United States is actually to take a leadership role in certain reactor technology, which it has held pretty much since the dawn of the industry, then very definitive action needs to be taken to ensure that the government, the whole of government, is there as a partner for the private sector to develop the type of technologies that are going to be utterly essential if nuclear energy is going to flourish and prosper in a way which allows us to achieve our national security objectives, that allows industries, innovative industries such as the tech industry, to deliver on AI. So the President Trump has represented the federal government as a business part of the private sector, and I don't think we've seen that invitation to the private sector done in such an emphatic way probably in 50 years. So this is a very important moment for the nuclear industry in the United States.
Simon, give us a sense of just kind of how the industry is laid out today. What % of our energy in the U.S. is provided by nuclear technology today, and where do you think it might be 10 or 20 years from now?
Well, it's just under. It's from electric. Nuclear energy today has been largely used for electric power generation, and its role in electric power generation is probably, it's about 18%. It's certainly dipping below the 20% mark. We're getting more efficient at operating advanced reactors. If you look forward over next, let's say 2 decades, there is a really real opportunity for that percentage to increase dramatically. And we've seen this before at other moments in the nuclear industry when nuclear energy, when the policy mix and the private sector mix and circumstances are correct, can actually scale remarkably quickly. So we've been, and I think that's the moment we have now.
Well, that kind of touches on what 2 things I was going to bring up, because in theory, what stands in the way of nuclear are cost and time. If you were to break ground on a new project today, it would still take quite a long time to get it up and running, and nuclear is expensive. Versus say, I need power today, let's get a solar farm up and running. Did these issues, or did these executive orders cut at any of these issues?
Well, nuclear certainly has been a nuclear power plant. Let's distinguish a nuclear power plant with nuclear energy. A nuclear power plant is what generates electricity, and nuclear energy has, a nuclear power plant has in the past been challenging to finance. It has required a tremendous amount of support from the public sector to get new nuclear built in the United States. But with respect to affordability, this is the opportunity to develop advanced reactors, and the executive orders last week recognized that advanced reactors are capable, because they use very different type of nuclear technology, Generation 4 technology, and it's Generation 4 technology that can be used to not only make nuclear power plants more affordable and you do that by making them smaller, so the absolute capital cost of the plant is lower. You make them modular. You make the designs to be such that you can repeat the same design on multiple sites. But the technology itself is also capable of delivering electric power, which is nuclear energy, nuclear electric power, in a much more cost-efficient way. So the Generation 4 reactors, and we're part of the Generation 4 class. It stands apart from the reactor technologies we've seen over the last couple of years, because over the last couple of decades, like water reactor technology, because it's capable of delivering high quality, high temperature thermal energy. With high temperature thermal energy, your steam turbines operate much more efficiently. You lower the cost of electric power generation with a nuclear reactor tremendously. With that type of operational efficiency you get from a high temperature thermal energy supply. But also with high temperature thermal energy supply, you can do something with a nuclear power plant for the very first time. You can use nuclear energy to directly supply the manufacturing processes that need thermal energy, not just power, they need heat. So with these Generation 4 systems, these advanced reactors that are part, the policy measures, the policy levers that President Trump pulled with those executive orders last week are in part directed at accelerating the development of these advanced reactors. And they deliver things from a nuclear energy perspective that we haven't seen before, but they're certainly so exciting in terms of what nuclear energy can do to the U.S. economy going forward.
All right, Simon, thank you so much. We appreciate that. Simon Irish, CEO of Terrestrial Energy. I think my take on energy supply and energy use is you got to put everything on the table. I mean,
yes, that's the thing.
I mean, maybe we don't necessarily need coal because you got natural gas, which is much cleaner and more efficient, but kind of everything. I don't know. Why wouldn't you?
Well, that's the thing, is if you're going to help one industry, in theory, you should help all of them. And the whole point of sort of nixing help for wind and solar is because the government shouldn't pick winners and losers. But in theory, making it easier for nuclear plants to get the go-ahead does just that.
Yep.
All of the above. I'm with you. Why not do all of the above at the end of the day?
I don't know. See, another season of Landman's coming up, so my education on oil and gas
When does it start,
continues.
though? Because I need to know when your next layer is here.
Yeah, I don't know. It's coming soon here, but it got green lit, so that's good news. S&P 500 up 1.6%. This is Bloomberg.